To me, the strength of the economy, that's a reason to expect a ceiling on how many cuts the Fed can deliver.
I think that the Fed is going to be a bit more prudent and only start easing much later in the year.
If they're not careful, they could cut rates and we could wind up with higher yields, not lower yields.
Central banks are really coming back into focus. We're going to get those cuts.
I'm concluding that the Fed put might actually be back.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance, your equity market positive by 0.4% on the S&P 500. What a snoozy start to a holiday-shortened trading week. It felt like the death of summer-style price action yesterday, Bramo. There's one word that sort of echoed around Wall Street: stretched. RBC, sentiment is stretched. BTIG, we're quite stretched. Just how stretched is this equity market?
It's a good question given the fact that Max Kettner, who's going to be on the show shortly, thinks there is no bubble. So he's stretched but not bubble. Therefore, what do? I don't know. Sit on your hands and hope for summer.
Julian Emmanuel saying this over at Evercore. He's going to join us on the programme a little bit later. We're in the exuberance zone. I guess my question this morning, AMA, is just how irrational is that exuberance in this stock market?
Well, it's a good question. We're hearing a lot of people talk about this. Have we gone over in the sense that you talked to Bob Michael, talking about it be the mid-2000s? Well, what happens then? It's the start of potentially the bubble bursting. So it'll be interesting to see what the data shows today and if the Fed actually takes it on board or if they ignore it and say it doesn't matter, to Mohamed Al-Larian's point, to us first on Bloomberg TV and then to the FT overnight, talking about the fact that doesn't matter for the Fed because are they now going to potentially start to move towards targeting an inflation range, not a pinpoint of 2%.
Do you think it's a contrarian indicator that Marko Klanovic is now less bearish? I mean, essentially, he's coming out and explaining how it can be justified. That basically, if you have central banks easing policy and you have earnings growth hanging in there, maybe it could be justified and sort of tiptoeing away.
Sort of basically describing where we are currently.
Correct. Did you see that?
I did see that.
I thought that was sort of interesting because he's been kind of bearish and contrarian, and I welcome the bearish contrarian feeling. But it just shows how it's difficult to be a bear right now.
AMH was talking about the Financial Times, front page of the FT this morning. See the far left side of that? Liz Truss moment in the US Treasury market. I thought of Bramo almost immediately, who coined that maybe a few months ago. Larry Fink of BlackRock just out with his letter this morning. Lisa, here's a quote from that. A high debt America would also be one where it's much harder to fight inflation since monetary policymakers could not raise rates without dramatically adding to an already unsustainable debt servicing bill, warning of the snowballing debt hitting the US economy.
This is a no-brainer. Honestly, everyone says this is eventually going to be a problem unless rates go to zero. This is not something that people are just throwing at a dartboard. The person who was talking about the Liz Truss moment was one of the heads of the Congressional Budget Office. We're talking about people who are in the government looking at how unsustainable this is. The problem is we keep talking about that. We've been talking about that for a while. When does it come into the price action? We've got a record 5-year auction today. My guess is we won't be talking about it tomorrow.
Just going through more lines of this annual letter, Annmarie, raising the prospect of a bad scenario akin to Japan's economy in the late 1990s and early 2000s as well. This is the kind of stuff that keeps coming up repeatedly on this program over the last few weeks.
Yeah, and we talk about this a lot because when you look at the budget progression, what we're going to see in the next 10 years is the top line item on the U.S. budget is going to be paying off our debt before we start to pay off our actual bills or things that society needs. More leaders should pay attention to America's snowballing debt, he writes. No leaders are going to be paying attention to that. It's election season. And then we already know next year there's going to be more debt because the tax debate is going to come full throttle to Washington, D.C. And whether or not we get Trump or Biden, on some level, those tax cuts will continue for some Americans.
We'll have that debate in just a moment with Greg Valliere of AGF Investments. I want to tell you as well that we'll bring you regular updates on the bridge collapse around the US port of Baltimore following a ship collision. Yahara is going to join us in about 10 minutes' time. Every 30 minutes or so, we'll bring you an update on that story. Let's start with the price action. Equity futures on the S&P 500, positive by 0.4%. That's the session high. In the bond market, yields of 423.56, down almost a basis point or so. We were up double digits, or rather down double digits last week. Then yesterday, we were up like 5 basis points and took half of that back. Lisa, I have to say, just looking at yesterday, what was that about?
I think basically from everything that I read, the trading options seem to suggest people wanted to hedge their bets about rate cuts coming through this year, about any rate cuts, let alone 3. It seems like people are worried about a Liz Truss moment. They're worried about what we heard from Larry Fink, and they just want to hedge a little bit in case this Goldilocks is getting a little bit over its skis. That's really all I could say about yesterday.
Quick note on crude. Just a little bit lower, down 1/10%. WTI 81.86, Brent crude 86.64. New 3Q price target over at Morgan Stanley, $90 on Brent by the third quarter on a tight oil market. And you saw what Mike Wilson had to say. Speaking of bullishness coming from the bears, bullishness on energy names. Bullishness on energy names.
Almost everyone's talking about bullishness, not only on energy, but also commodities more broadly, which raises this question: at what point does the robust growth and the easing policy of central banks enable inflation stemming from goods and commodities, in addition to other places?
Coming up on this programme this morning, Max Kettner of HSBC on why he says the stock market rally is not a bubble. Greg Valliere of AGF on our new Bloomberg Morning Consult poll. And Pooja Sriram of Barclays as the Fed emphasises caution. We begin with our top story, investors debating whether the stock market rally has run its course. Max Kettner of HSBC remaining constructive, writing this: risk asset valuations may be late cycle and look like a bubble, but lots of macro variables increasingly look like early cycle. Max, I'm pleased to say, joined us now for more. Max, I want to begin, not with that note, but earlier this year. You came out in 2024, looking back to a 2023 where you were very bullish and right to be so, and you made a change. You called it reverse Goldilocks. Essentially, what you were anticipating was better data, leading to a repricing of interest rates higher, and ultimately causing damage in the equity market. You got the first half of the story right, struggled with the second half, Max. Why the change?
Yeah, look, I guess, what we didn't get right was that interest rate volatility didn't increase, right? You're right. When we look, for example, at shorter dated inflation expectations, they did increase, right? We've seen January and February CPI data clearly surprise to the upside. And we have seen longer dated real rates up. We have seen the long end of the yield curve up, right? We've seen all of this. But contrary to last September, October, contrary to last February, for example, we've not seen interest rate volatility go up. And that usually is the one thing that sort of is needed to weigh on equity valuations, to bring, equity multiples down and then to sort of spread a bit across the asset classes. That really is what's been missing. And to us, look, when we look at longer dated forwards, they're already at sort of 360, 350, 360. So even if we do push perhaps towards 4%, at least half, maybe 2/3 of that story is gone. So that's why, about a month and a half ago, we said, look, even after such a short time, it doesn't pay to be bearish, right? The data is way too good. You've got to stay bullish, and you've got to stay bullish on equities and on high yield in particular.
And you are bullish stocks, bullish credit. So, Max, is this a tactical call, a short-term call, a window where you think we can do okay? Or is this a longer-term call?
No, I think it's at least for the next couple of months, right? It's not something where I would expect next week to say, actually, let's reverse course again and let's say the exact opposite again. No, I do think that can go well into the second half of this year. Perhaps then, right, towards perhaps the Q3 reporting season. So in October, November, we are seeing, obviously, the US election, perhaps a bit of election volatility. But more crucially, earnings expectations then are much higher, much more challenging to beat. We might also see, perhaps the Fed and then perhaps the discussion that you guys were just having around the Fed. We might have this discussion come to the fore where, we might start to discuss, can the Fed really cut 4, 5, 6 times? Can they cut down to 4, or can they cut down perhaps even to 3? Or are they stuck at 4, or perhaps even 4.5? Or might they even have to reverse course again in 2025? That discussion, I think, for the next 5, 6 months, we can sort of forget about that, because so far, I think central bank policy, particularly with regard to the Fed, is very, very binary. They either cut or not. And to be honest, as long as they cut, I think we're still going to have a great relief rally in equities and high yield and risk assets more broadly, because there is still so much cash on the sidelines.
So just to sit on that for a second, you don't think it matters whether they cut 2 or 3 times or even just 1 time? As long as they cut it all this year, that's enough to keep this rally going in a significant way. Why?
Yeah, absolutely. I think, there's those kind of charts floating around right now. where people just look at December 2024 Fed funds futures versus the S&P and this big wedge opening up, right? This big divergence opening up. I think this chart kind of doesn't make sense, because what really matters is the starting point where then the market can really start pricing interest rate cuts. Once the Fed then has started to cut once, twice, perhaps 3 times, and then in the second stage, we start discussing about, hold on, now that we are in the cutting cycle, how far is it actually going to go, right? How far are they actually going to go? That then, the second stage, will be crucial. But the first stage is simply this binary nature. It's this, are they going to cut or are they not going to cut? And there's still an awful lot of investors that are, a bit contemplating, with this revival of growth, with very easy financial conditions, there is a risk that they won't cut at all. Let's not deploy all the cash that we have on the sidelines. So I think once the fact is happening, I think there is still a lot of cash on the sidelines that then will be deployed in markets.
You said it doesn't pay to be bearish. And that makes me very nervous. It makes a lot of people very nervous, given the fact that typically a two-sided market tends to be healthier. Ed Yardeni yesterday was talking about Alan Greenspan in 1996 when he talked about irrational exuberance, and that was sowing the seeds for the internet bubble. Are we in a similar period where it doesn't pay to be on the other side of a rip-roaring rally that potentially is headed a little bit too high?
No, absolutely not. I think that's. I'm going to throw something at you that you cannot argue against with, because I've seen a survey, I think from Bloomberg, I think one of the M Live surveys last week, where you guys were asking, is this a bubble or not? And interestingly, I thought it was around 45% saying it is a bubble, and another 45% were saying it's not a bubble. I would be really genuinely concerned if you had sort of 80, 90% of the people saying it's not a bubble. I think that would absolutely validate your thesis around irrational exuberance. But as long as it's still so sort of pretty balanced in terms of the views, that to me is not really bubble territory yet, right? And in terms of the macro data, when we look at things like CEO confidence, consumer expectations around their financial situation in the future, when we look, for example, at global manufacturing leading indicators, right? When we look at now globally, central banks moving away from hikes towards cuts, where we should be starting to talk about the lagged impact of monetary easing, all of those things look much more like early cycle, not like a late stage or close to recession thing. So that's why I don't think it's really, really bubble territory. And one last point, when we look at the S&P, it's only around 9% higher compared to the peak in early 2022. However, if you look at US nominal GDP since then, it's actually up 13.5%. So you can make the argument that particularly some of those cyclical sectors that have gone through a proper earnings recession, that they really have some catch up to play on the earnings side.
Got to be careful, Max, with any survey that Bramo has access to. Just sits there clicking it. Saying bubble.
Oh, you think I'm trying to skew
Just
that?
saying, you have the potential to distort surveys.
You think this is why the University of Michigan doesn't call me?
Voting loads.
Is that really it? You just
maybe. Because you'd be the kind of person
do?
that if they did call, you'd be like 10% over the next 1 to 5 years.
That's what you want to do.
Max Kettner of HSBC. Max, thank you, sir. We promised you some updates on the bridge collapse in Baltimore. Here's the first big one this hour. Maersk says the ship that it chartered caused the bridge collapse. That headline crossing just moments ago. Maersk coming out and saying the ship that it chartered caused the Baltimore bridge collapse. Bramo, that stock is down by 4% at the moment.
After a pretty volatile period, the company is saying we are closely following the investigations conducted by authorities and Synergy. Question here really lies with liability at this point, if they did charter it, although they did say no Maersk crew or personnel were on board the vessel.
Let's get you some updates on that story and a whole lot more. Here's your Bloomberg brief. Here is Yahara Haquez. Hey, Yahara.
Hi, John. We start with a warning about graphic images. The Francis Scott Key commuter bridge in Baltimore has collapsed after being rammed by a container ship. The Associated Press reporting at least 20 people and multiple vehicles plunged into the Patapsco River. As you said, Maersk says the vessel was under its charter. The bridge is a major part of the road network around Baltimore, carrying more than 11 million vehicles a year. Motorists have been advised to avoid the I-695 interstate this morning. Florida Governor Ron DeSantis signing a bill limiting access to social media accounts for minors under the age of 14. The law would require parental permission for 14 and 15-year-olds and would force all social media users in the state to submit identification documents to verify their age. The move comes as some states clamp down on social media platforms over mental health concerns and their role in spreading sexually explicit content. And WeWork co-founder and former CEO Adam Neumann offering to buy the company for more than $500 million, according to the Wall Street Journal. It's unclear how Neumann would finance the deal, which comes 5 years after he was ousted by the board. WeWork is currently undergoing restructuring efforts to emerge from bankruptcy in the second quarter. That's your Bloomberg Brief. John?
Yahara, thank you. Was that almost a round of applause for Adam Neumann?
100%.
That was.
He won. He won the pandemic.
Without a doubt, he won the bubble era, I think. Made all that money from a company that eventually went bankrupt, and now he wants to buy it back again.
At a discount. Sell
Just
high,
absolutely
buy
amazing.
back low, cash in the meantime, and be a rock star.
Incredible. We're calling him a rock star.
Well, he kind of exudes that feeling, where he gets up. I'm sure if Dan Ives were here,
walking around, no shoes and socks, long flowy hair.
Exactly. Exactly. You understand.
Totally.
Yoga.
Sure. Up next, a trial date set for Donald Trump.
I don't know how you can have a trial like this in the middle of an election, a presidential election. This is election interference. They are doing things that have never been done in this country before.
That conversation up next, live from New York City this morning. Good morning. It's a small bounce on the S&P 500, up by 0.4%. Looking at the bond market, yields a little bit lower, down a single basis point, 422.97. Under surveillance this morning, a trial date set for Donald Trump.
We have a man who just ruled he'd like the trial to start in 21 days or something. And I don't know how you can have a trial that's going on right in the middle of an election. Not fair. Not fair. I don't know how you can have a trial like this in the middle of an election, a presidential election. This is election interference. They are doing things that have never been done in this country before.
It's the latest this morning. Former President Donald Trump's first criminal trial set to begin on April 15th. The case centering around hush money payments he made during the 2016 campaign. Separately, a New York appeals court allowing Trump 10 days to post a reduced $175 million bond in his civil fraud case. Despite the former president's legal woes, he's still holding a steady lead over President Biden in 4 key swing states, according to the latest Bloomberg Morning Consult poll. Joining us now is Greg Valliere of AGF Investments. Greg, let's talk about our new poll out this morning. Are we narrowing the gap between the two leaders?
I think so. I mean, it's a poll you have to take seriously, John, because there were 5,000 people polled. It's still March, obviously, and a lot can change. I think there'll be 4 or 5 momentum swings during this campaign, maybe even more. But this is significant for a couple of reasons. One is the public seems to feel the economy is getting better. That's a big shift. And more people are saying they're not voting for Biden. They're voting against Trump. That's something Trump has to worry about.
When you look at the poll, Wisconsin, Biden is now leading Trump by 1 point. He trailed him in February, and then he's tying him in Pennsylvania and Michigan. How critical is the blue wall to President Biden to getting reelected?
That's a good point. I mean, you've got to win those states. What Biden has going for him, though, is money. Believe it or not, the Democrats and Biden have far more money than the Republicans and Trump, and I think that will make a difference.
How does Trump gain more when it comes to campaign donations? Do you think potentially his social media company and this merger, and they're going to start trading officially today, we see it up in pre-market, can help him? This looks like a huge windfall for him.
Yeah, it sure could help him, although, the public might say he's just spending all of his own personal funds on this, and it might create a backlash. Hard to say on that. Of course, Trump has a long history of not spending any of his money when it comes down to it on his own campaigns. He finds others to spend the money.
Well, we were talking about all of these trials that we started with the former president talking about how unprecedented this is and how it's complicating his effort. Is it complicating it or actually adding fuel to his ability to raise money, since all of these trials have traditionally been fundraising opportunities?
I think it's the latter. I think he can raise money off of this, claiming that they're taking his properties away or treating him unfairly. He says we're in the middle of an election. Well, it's still March. I wouldn't say we're in the middle of the election, but he plays martyr better than any politician I have ever seen. And I think he'll do that again very effectively.
In the meantime, we're wondering what President Biden, what the ramifications will be from some of the U.S.'s policy with respect to Israel and Gaza, given the fact that the U.S. did not veto the latest resolution at the United Nations calling for a ceasefire. There's been an increasing kind of tension between the U.S. and Israel. Do you think that that will bolster President Biden when it comes to support from the more progressive wing?
It may help him with the progressive wing, but at the same time, it might hurt him in a state like Florida that has a heavy Jewish population. When you see Netanyahu and Biden not even speaking to each other, that's shocking. I mean, the Israeli-U.S. ties over the last few decades have been rock solid. Now they're not.
What do you think Biden's response to this should be, in the sense that, do you think people are going to go out and vote on foreign policy November? Or is it just something that he needs to do to make sure that he's shoring up some of these smaller bases in places like Michigan?
Yeah, I think he needs to shore up bases. I'm really intrigued by the finding in this new poll that people now see the economy getting better. They're probably looking at the stock market, which has been rocky for the last couple of days. But as you know, the stock market's been pretty good for the last couple of months. I think that's a real plus for him.
Yes, the economy, do people feel like it's getting better? But if you look into the poll, people still trust Trump more when it comes to interest rates and everyday pocketbook issues. How does Biden change that?
Well, I think he's got to stay on message and talk about tax cuts for the rich, things like that. Let me just add one other really interesting wild card, and that's Robert F. Kennedy. He's probably going to announce today his running mate. I'm shocked to see in some polls Kennedy is at or above 10%. He could have a big, big impact.
Just in the around the world kind of moment in politics that we're having with you, Craig, I do want to just finish up with something a little different, honestly, that probably markets care a little bit more about in the front and center, which is the tit for tat around tech between the U.S. and China that seems to be heating up. Overnight, we did hear about China potentially banning the use or limiting the use of U.S. produced technology in government super infrastructure. How much is this going to really lead to some sort of response from the U.S. and highlight how much this could potentially escalate into the November election?
Well, the friction is real. I'm encouraged to see that Janet Yellen is going back to China in the next couple of months. But I think there's a need for really serious negotiations. I think U.S.-China relations are another big, big wild card and a negative one potentially for Biden.
Hey, Greg, always good to hear from you, sir. Greg Valliere there of AGF Investments. More on that morning consult Bloomberg poll in just a moment. Stunning pictures coming out of Baltimore overnight. Let's get some of those pictures up now for you. The Francis Scott Key Bridge collapsing in Baltimore following a ship collision. Two updates in the last 20 minutes or so. The first coming from Maersk, the container shipping company, saying a ship it chartered caused the Baltimore Bridge collapse. That stock is negative in today's trading. This from the White House just moments ago, Anne-Marie, saying no indication of any nefarious intent in Baltimore.
Yes, the White House obviously will be getting briefed on everyone, including all the local personnel that's on the scene there. And we do know there has been a ton, given this attack took place early morning. And they're saying no nefarious intent right now in Baltimore. They're obviously going to be monitoring the situation. But this is a situation where, we're talking about Maersk, but people are potentially going to be drowning. This is a number of cars that fell off this bridge, and there's going to be a tremendous amount of local authorities on the scene there. And I imagine the White House at this moment will be monitoring every single situation, every single moment of the situation.
Still piecing together what happened here. I promise you another update in the next 20 minutes or so. Let's turn to financial markets just briefly. Equity futures on the S&P 500 shaping up as follows. On the S&P 500 bouncing back by something like 0.4%. Yields a little bit lower by a single basis point, 4.2316. Plenty of Fed officials speaking, Bramo. I have to say, pretty consistent with what we heard from Chairman Powell last week.
Yeah, although Raphael Bostic was interesting. He used to be the dove. Now he's the hawk by saying he only thinks one cut this year. So, you know, an interesting sort of shifting of the birds.
I know you're focused on cocoa futures as well. You see that?
That's awesome.
$10,000 a ton.
Not awesome.
I'm not sure how awesome that is to some people.
Well, it's not awesome. It's terrible.
Not ahead
but
of
it's
Easter.
just amazing. It's sort of shocking.
I can just feel, I'm anticipating just how bearish the conversation that's about to take place in about 5 minutes is going to be. Let's start with the price action. Equity futures on the S&P 500 positive, bouncing back by 0.4%. The Nasdaq yesterday snapping a 5-day winning streak. Very muted losses, I have to say. Really marginal stuff. We're higher today by 0.5%. If you switch up the board and get to the bond market, the upgrades, the catch-up in the bond market from Goldman yesterday, raising the year-end 10-year target to 4.25 from 4%, which is basically where we are currently. The 10-year 4.2316, down a single basis point at the front end of the curve. Lisa, down 3 or 4 basis points. Let's call it 460, 458.89.
We were talking about this yesterday with Jim Bianco. At what point does the long end wake up to the idea that this Federal Reserve is allowing inflation to run hotter for longer? It's really a key question. Right now, we're not seeing it at all, even with another record auction today of 5-year notes. How much are we going to see that sort of start to the fore, especially heading into the election?
You know what the cheat code is now in consensus? What you hear is this. We'll get a steepener. OK, and basically it's a cheat code because you get to say the front end's going to rally because we'll get a couple of rate cuts.
Right.
And something's going to happen at the long end, but I can't talk too much about that. But if you ask them to be specific about where they think the 10-year yield is going, that's where they start to struggle, I think, because to your point, if you get inflation starting to inflect higher, maybe just stabilising around higher levels, you start to factor in maybe a Fed that is looking at a neutral that's got a 4 handle, not a 3, not a 2, then you're in a very different place at the longer end of the curve.
I get the sense there is a great degree of humility right now from a lot of strategists, whether it's bonds or stocks, by the wall of money that keeps flooding in. And people who theoretically could make a case for why yields should be higher are seeing the money just keep flooding in and not seeing the case to really bet against it, which really raises the question, what makes it wash out? And really, that is one of the key questions. Or will it always be there? And if that's the case, you have to reset at a different level.
We'll dig into that theoretical case in just a moment. Let's turn to foreign exchange. The euro at the moment shaping up as follows against the US dollar. The euro stronger, positive. We're at 108.63 and positive by 0.25%. Under surveillance this morning, divisions growing between Israel and Washington. The Israeli government cancelling a trip by senior officials to D.C. The decision coming after the White House opted not to veto a UN resolution demanding an immediate ceasefire in Gaza. The office of Israeli Prime Minister Benjamin Netanyahu had demanded the US veto the resolution. The US abstained, citing a failure to explicitly condemn Hamas for its October 7th attack. Monday's resolution marking the first time the Security Council has openly endorsed a ceasefire. Annmarie will catch up with the Israeli government later this morning.
Yeah, we will. Ron Dermer. And this was an individual that was supposed to be heading to the United States. This trip now suspended because the U.S. decided not to go ahead with that veto. They abstained from this vote. The U.S. saying they're very disappointed. But we've been seeing it for weeks, whether it was over the weekend, Kamala Harris's interview saying she's not ruling anything out when it comes to consequences if Israel was to go into Rafah. And then, of course, that really groundbreaking speech by Senator Schumer saying Netanyahu should be stepping down. The gap keeps widening between Netanyahu's government and the Biden administration.
Let's listen to the response from the Biden administration so far. And it goes something like this. Nothing's changed. Why the overreaction? What did change for Israel yesterday, which essentially is going to be my first question in about an hour from now? What do you believe changed? Because the US is turning around and saying, you're making a big deal of this. Nothing's changed.
Well, it's the first time the UN, even though many really question whether the UN has any authority for this, but the first time they have openly endorsed a ceasefire. But I don't know if it was just this moment. This potentially was a moment for Netanyahu to push back on all the rhetoric I just mentioned, whether or not it was Schumer, Kamala Harris. You do see they really are starting to, it's becoming more of a wider gap between these two governments.
Here's a story on Lisa's radar. I want to talk about China just briefly. A handful of US CEOs reportedly extending their stay in Beijing for a Wednesday meeting with Chinese President Xi Jinping. A list of executives invited to attend hasn't been made public, and sources telling Bloomberg there is a, quote, understanding Xi will be there. His name isn't listed on any invitations. The same tactic was used back in November when he attended a dinner with US business leaders, executives including the Pfizer and FedEx FedEx CEOs already in Beijing for the China Development Forum, which ended on Monday. Bramo, what do you make of this?
I'm not sure. Is this going to be an outreach to try to get them to stay? Or is this going to be a really frank conversation with some of these executives about why they're unclear about how quickly and how much they can really commit to a country that doesn't seem committed to them? I mean, we look at foreign direct investment, coming down for a second straight month. This has been an issue perpetually for companies that want consistency, if nothing else. So to me, it's interesting that they're all there kissing the ring. Do they get some sort of promise in response that they can bank on?
Yeah, I think things have changed, haven't they? It used to be them rolling out the red carpet for Xi. It feels like Xi is now rolling out the red carpet for them.
Maybe. Let's see how serious he is about this. He did that in San Francisco to some degree, but I am curious to see whether it's the same kind of tone, especially given the fact that all of the public proclamations by officials are pretty sanguine on the economic picture.
Whether or not first off, we have to make sure she actually does intend to go and actually shows up. But it's really the optics of this. I think what he's trying to show to the rest of the world is that we want foreign direct investment. We want you to come to China. The issue is it comes at a moment when also just ahead of the Treasury Secretary set to go, according to Politico. So does this pave the way for potentially that more frank conversation he's going to have with the U.S.?
That's China. Next story out of BlackRock, the CEO, Larry Fink, warning of a mountain of debt hitting the U.S. economy in his latest annual letter. Fink saying the nation can't rely on taxes and spending cuts to get the problem under control. More leaders should pay attention to America's snowballing debt. A high debt America would also be one where it's much harder to fight inflation. Fink saying a debt crisis is not inevitable, calling on capital markets to help grow the U.S. economy through infrastructure and energy investments.
I'm just looking at this. How do you pay for it? I mean, this is ultimately the question is, first of all, there's a lot of disagreement about how you grow the economy. And then the second question is, what are proper investments to pay for at a time where it's getting more costly to borrow? It's a real debate. I'm not saying this with snark. Honestly, I don't have the answer. But this is where the debate should be in Washington, not some of the things where it has been focused.
Grow your way out of it is going to be the response we hear from Washington.
Yeah, well,
let's see how that goes.
But do you grow it out of it by cutting taxes? Does that happen proven
That's
to work?
That's going to be one offer down in D.C. from one party.
Right.
Yeah.
Is it going to be removing restrictions for businesses? That's going to be one party. Do you invest in infrastructure? OK, well, then how do you pay for it? And how do you justify something that has earmarks?
Another party would say we tax the 700 and something billionaires that live in America, and that will address everything.
Point being, a lot of people would agree on the premise, but not necessarily the resolution.
Let's get another view. Larry McDonald, founder of the Bear Traps Report, warning that the, quote, fantasy of a return to normal is unlikely. In his new book, How to Listen When Markets Speak, he writes this: an unprecedented era of easy money is coming to a screeching halt. We're about to witness a new era defined by sustained inflation, a series of sovereign and corporate debt crises, and a historic multi-trillion-dollar migration of wealth. I'm pleased to say that Larry joins us now for more. Larry, good morning and congratulations.
John, thank you.
Thank you very much for being here with us. Can we get into that? The word crisis seems to come up a lot. What are you anticipating is going to happen? And do the thoughts of Larry Fink this morning resonate with you?
Well, first of all, gratitude. I'm so grateful to be here with you guys. I'm coming up on 20 years on the Bloomberg terminal, and that's a long time. And, we have a great institutional business, and this book democratizes information for the viewers, right? And so we've been having these conversations for the last couple of years with the professional investors. And what we want to do is bring kind of the intelligence gathering that we've done around the world over the last couple of years and bring it out to a broader audience. And the bottom line is everybody in America, everybody's 401k is set up in a 2010 to 2020 portfolio. And that was really a disinflation decade for a whole bunch of reasons. Post-Lehman, I was fortunate enough to write the Lehman book. And now this is about the 2020 to 2040 portfolio, which is right now there's about 22 trillion in the NASDAQ 100, $22 trillion in financial assets. And then when you look at hard assets like copper, aluminum, oil and gas, things that are going to really bring forth our economy to the next generation, you're only talking about $3 trillion in those entire asset classes. And that's what this is all about.
So this raises this question of how do you get the ball of money or this wall of money or whatever you want to call it to shift in those directions? And is there enough to go around? Is there basically not the fear of massively rising yields because there just is so much cash that's been created by the 2010 to 2020 decade?
Well, this year is very political because it's obviously an election year, and we've had a disinflation cycle. I guess a a disinflationary moment here in the last 3-4 months where inflation came down. And a lot of people are encouraged by that. And so that's brought on a lot of cheerleaders. We're going back to the previous world. And when you look underneath the surface, it's a multipolar world. We've got sea lanes that aren't working properly. We've got drone attacks on refineries. This is a different world. And so the probability that inflation normalizes 3 to 4 instead of 1 to 2 is extremely high. And if that's the case, there's trillions and trillions of dollars that are basically in the wrong place.
What's going to be the wake-up call? Because we've been talking about a Fed that basically just said we're going to allow inflation to run hotter for longer. Markets don't seem to be particularly alarmed by that. When does that change?
Well, they have to think about when you have a $35 trillion debt hole, there's 2 ways out. Debt jubilee, and we've seen that going back the last couple thousands of years. Civilizations have gone toward a jubilee. We won't get into that kind of bearishness. But the other way is to monetize your way out. And so they won't tell us that that's their plan. But when you look at, say, the Fed meeting and the post and all the questions that come out of it, nobody's asking the Fed when he says higher for longer, right? When he says that, somebody has to ask, well, if it's $80 billion a month of interest, how can you stay higher for longer? At some point, they're going to have to really hold down that front end. And right now, 80% of all debt issuance is in T-bills with that kind of massive amount of debt issuance. And so you can just tell they're trying to play the waiting game. Eventually, they're going to have to suppress the front end to get us out.
That's the sovereign story. Just how well understood is the corporate story? I mean, we have a decent understanding. There is some transparency there around the maturity wall and how much of that has already been basically taken down in the supply of the first quarter of this year. How well understood is the corporate side of the story?
Well, I just look at the super regional banks like Zions and Comerica and U.S. Bancorp. They're underperforming the S&P 500 by over the last 2 years by close to 40-50%. That's very unusual. So that tells you that there's a debt problem either in commercial real estate or on the corporate side that's out there. But the corporations did a really great job of, as you guys have shown, pushing out the maturities to 24, 25. But the problem is we have in 24 and 25, and say the next 24 months, if you add up all the commercial real estate loans plus the leverage loans plus high yield and investment grade, it's like $2.5 trillion. So that's going to be an issue probably for later on in the year.
So you clearly think there's something highly incompatible about where the market is versus where you think the regime is going to relative to where we were, say, 10 years ago. And I'm trying to work out, how do we get 10, 20 years down the road in this cycle, this new regime that you think we're in at the moment, if we've got to work through all those debt issues? I'm not sure how the two things are compatible, that ultimately if the Fed has to stay high for longer because you believe inflation is going to be a problem for a lot longer, doesn't that just address itself?
Well, typically, this kind of debt load would cause a financial crisis event. We saw that last year, right? But look what happened. The moment they smelled the Lehman moment, the Fed, they juiced the balance sheet, and they're going to basically attack any financial problem with rate cuts and balance sheet. So at the end of the day, that gets you into a weaker dollar regime, because that's one way out of a financial crisis, right? Is now they've got all this firepower. They got 5.25% of rate cuts, so they can really attack a financial crisis aggressively with rate cuts. If they do that, that gets you a much weaker dollar on the heels of what's happening in commodities. Then you're going to have the real big commodity boom.
Which is the Liz Truss moment, when all of a sudden the U.S. loses its reserve currency. This, to me, is really the key question, though. Ultimately, is this a matter of the leverage shifting away from the private sector to the government sector, and for the Fed to have to rescue the government by keeping rates lower and allowing inflation to running hotter? How hot are you seeing inflation potentially running? Are we just talking 3%, 3.5%? Are we talking about something more in the fours that really does kind of weigh on people who do go to stores and see their grocery bills picking up quite materially?
And that's the thing, is that right now the boomers control about 76 trillion of wealth. 76 trillion of wealth, whereas the millennials control about 8 to 9 trillion. So the boomers are sitting on a lot of capital. They're getting a tremendous amount of money in the banks, in the money market funds. But the bottom 30%, the bottom, say, 60%, are just being suppressed with higher inflation, and they have about $400 in their checking accounts. That's according to the New York Fed told us that, remember? So they had $400 in their checking. So it's really two economies. One economy is booming because Powell gave the wealthy boomers a 300% pay raise. The bottom 60% under this inflation stress. And then you could see this in some corporate earnings, right? You can see it in McDonald's, you can see it in pet care. It's two economies that are kind of fighting it out right now.
I have a feeling we'll be talking about this for a long time. Larry, it's good to see you. Congratulations on the book. It's fantastic to catch up. We're going to do this again soon. Larry McDonald there on his new book. Let's get you an update on stories elsewhere this morning, an update on the bridge collapse in Baltimore. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. We start by warning you, these are graphic images. Baltimore's Francis Scott Key commuter bridge has collapsed after being struck by a container ship in the early hours of this morning. Emergency responders have described it as a, quote, mass casualty incident, with as many as 20 people and multiple vehicles plunging into the water. Baltimore's fire chief says 2 people have been recovered from the water so far. In an emailed statement, Maersk saying the container ship Dolly was operating under its charter. The White House says there is no indication of any nefarious intent. Troubled electric car maker Lucid is getting a $1 billion cash injection from its biggest investor, which is an affiliate of Saudi Arabia's public investment fund. The U.S. company saying the new financing will be partly used for capital expenditure and as working capital. Lucid shares gained nearly 6% yesterday, though they are still down by roughly a third so far this year. Former President Donald Trump's social media company is rising ahead of its first session as a publicly listed company. Trump Media and Technology Group will begin trading today on the NASDAQ under the ticker DJT following its merger with a so-called blank check company, or SPAC. The deal gives the parent company of Trump's social media platform, Truth Social, more than $275 million of much-needed capital, plus providing a windfall for Trump as he faces a mounting series of legal and financial issues. That's your Bloomberg Brief. John?
Hey, Hara, thank you. Up next on this program, the Fed proceeding with caution.
The risk of easing monetary policy too soon or too much is that it could allow above-target inflation to become entrenched and halt the progress that we have seen.
And that conversation up next. You're watching Bloomberg TV. Fascinating conversation with Larry. So essentially, just to conclude, I spent the commercial break thinking about it. We're going to have to pay for financial stability with higher inflation, right? Is that basically the trade?
And pay for a deficit that otherwise would be completely unsustainable with inflation, to inflate our way out of it at the expense of the dollar. Because essentially the Fed is going to have pressure, even though it's not political, to cut rates to bail out the government rather than the private sector, because the government is where the debt is actually.
Got it. This is pretty bearish stuff, isn't it?
It's bearish stuff, but he's not alone. And it sounds gloom and doom and kind of, end of times, but Larry Fink was kind of nodding to this.
Yeah, he was. In the annual letter to shareholders a little bit earlier this morning. More on that later. Equity futures right now on the S&P positive by 0.4%. In the bond market, yields lower by a basis point or two, 422.77. Other surveillance this morning, the Fed proceeding with caution.
The risks to achieving our inflation and employment goals are moving into better balance. The risk of easing monetary policy too soon or too much is that it could allow above-target inflation to become entrenched and halt the progress that we have seen.
Here's the latest this morning. Fed officials emphasising caution with more economic data on deck. Durable goods due today at 8:30 Eastern Time. PCE on Friday. Pooja Sriram of Barclays expecting, quote, 3 incremental cuts in 24, 4 more in 25, lowering the target range for the federal funds rate to 350 to 375 at the end of next year. Pooja joins us now for more. So, Pooja, that sounds like a little bit of a rate-cutting cycle, when I have to say some people on the street are starting to look towards maybe just a mid-cycle adjustment of a couple of rate cuts and then wait, see, and look around. Why are you in the former camp and not the latter?
Hey, thanks for having me on the show this morning. I think 2 reasons. One is, of course, our own baseline outlook of how we think the data are likely to evolve. which was, where we were before the March FOMC meeting. We had the same expectation. We think there is a plausible path where we see inflation continuing to gradually decelerate, through the end of this year, which gives the FOMC, the right chance to, initiate a rate cutting cycle. And at the same time, we do think that there is a gradual slowdown in the macroeconomic backdrop that is quite likely. So a slowing, but, nothing more than that. And then we've always been saying that risks to this baseline outlook, looked skewed in a sense that, we could have fewer rate cuts or, more delayed rate cuts. And that was really what we were starting to see after the Jan and the Feb inflation data. What really took us by surprise is the March FOMC meeting, the press conference, the SEPs, which gave us, a little more understanding of how the Fed is thinking about this, what their reaction function might be. And, the read from all of that was that it seemed quite dovish. And it seems like, they're also looking for a window to go in there and start cutting rates. And that really aligns with what we had expected earlier as well.
Pooja, a lot of people have come on this program and said that essentially the March pivot or the continuation of the December pivot highlights that this Federal Reserve is going to be tolerant of inflation at a higher level for a longer period of time. Why aren't you seeing that really reflected either in economist projections or in market expectations?
So I think we wouldn't read it as, them being tolerant of higher inflation expectations or inflation outcomes. I think what we learned from the March FOMC meeting is they are, they didn't infer much from the Jan and February inflation prints. I think their baseline outlook remains one where they expect the future inflation prints to evolve lower. So nothing, for them has materially changed in terms of their baseline forecast from December to March. Of course, it's, a lot of participants did note that risks to inflation are skewed to the upside. So they're definitely cognizant of that. And I think Chair Powell was also clear that every meeting is live. It's going to be data dependent. So nothing in that seems to suggest that they're going to be tolerant of higher inflation. It's just that at this point in time, they still very much believe that they have a path to lower inflation, even with the strong macroeconomic backdrop, and they really believe that they will find a window to cut.
Why don't you think that a higher tolerance of inflation is implicit in the forecast? Isn't that in the SEP?
So the SEP actually has inflation coming all the way down to 2.2% by 2025. And this is despite them marking their growth forecasts higher with a very benign unemployment rate. So, that if you were to look at the projections, I think they believe that they will have core PCE inflation close to 2% by the end of next year. And that allows them, to have a slightly shallower rate path and to proceed with the rate cuts that they have projected.
So your projection is 350 to 375 at the end of next year. Pooja, could you share with us where you think neutral is?
Oh, well, so here's what we think. I think rather than looking at the long run projection for the FOMC, I think, tend to think that, where the 2026 median rate projection is about 2.9 is perhaps where, the policy setting should be. That's a slightly higher neutral rate than we had in the past. But I think the 2026 median projection is perhaps where we think the neutral rate currently stands at.
So low threes, Pooja, is basically the guess from you. So you'd still suggest that even if we come down to 3.5, that's somewhat restrictive for the US economy. Is that right?
That's correct.
Is that because you believe maybe this inflation story is going to hang about longer than expected?
It could be. I think one thing that we need to understand is, they don't need to wait for inflation to come all the way back down to 2% to actually start cutting rates. We just need to be confident that things are evolving in the right direction. And I think we'll find a window for that to happen. And a slightly higher neutral rate, I think, is a consequence of more macro fundamentals. Slightly higher productivity. We've got demographics. There's also the immigration story that the FOMC has alluded to earlier, right, where we think that there is a very positive aggregate supply shock, something that I think they continue to expect in their baseline, which perhaps also explains why we could see a slightly higher neutral interest rate.
Thoughtful stuff. Appreciate your time, Pooja, as always. Let's catch up soon. Pooja Sriram there of Barclays on the Federal Reserve. Coming up in the next hour, Julian Emmanuel of Evercore, Bloomberg's Mario Parker, Israel Strategic Affairs Minister Ron Dermer, and Megan Robson of BNP Paribas. From New York City, the second hour of Bloomberg Surveillance. Up next.
To me, the strength of the economy, that's a reason to expect a ceiling on how many cuts the Fed can deliver.
I think that the Fed is going to be a bit more prudent and only start easing much later in the year.
If they're not careful, they could cut rates and we could wind up with higher yields, not lower yields.
Central banks are really coming back into focus. We're going to get those cuts.
I'm concluding that the Fed put might actually be back.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance begins right now with your equity market pushing higher, bouncing back by something like 0.4% on the S&P. That's the S&P 500 yesterday briefly, just snapping some of the momentum we've got on the Nasdaq, a 5-day winning streak on the Nasdaq 100, but really muted, mild stuff coming into the big print on Friday. The print we've been waiting for, and Chairman Powell basically told us what the number is.
0.3%. So this is basically where we are, which is the reason why we can take the day off. So thank you. We really appreciate it.
So we get back to the equity market going into Friday, trying to figure out just how stretched we truly are. Julian Emmanuel of Evercore on the show in about 2 minutes' time. Stay tuned. We're in the exuberance zone. First question, irrational or not?
And how long can exuberance last? Longer than many people can remain solvent. This is the issue, is that a lot of people could identify something that feels like it's getting frothy, and yet it can continue for a very long time. To me, the one key question really does remain with the bond market. How long will the bond market go along with the message that the Fed intends, which is everything is under control, we're doing just fine, we're going to cut rates, inflation's going to come down? When do people start to challenge that, and does that shake some of the exuberance?
I love what you just said. We can all identify a story that sounds bad, but it can remain bad for a long, long time. And I'm thinking of the fiscal trajectory of the United States of America. Earlier on this morning, Larry Fink, the CEO of BlackRock, coming out with his annual letter to shareholders and saying this: a high debt America would be one where it's much harder to fight inflation since monetary policymakers could not raise rates without dramatically adding to an already unsustainable debt servicing bill. Complaints this morning, AMH, a warning of the snowballing debt in the U.S.
Yep, and he says leaders should be paying attention to it. He also talks about the cost of servicing the debt, how much that's ballooned, and 3 percentage points in extra interest rate payments the U.S. government must pay. He calls that, quote, very dangerous, although he does say as well about a looming retirement crisis. He says he understands why millennials, Gen Z, are annoyed with the boomer generation like him, because they're going to be the ones that have to pay for all of this.
I will say there will be a lot of people who dismiss this. He's trying to act a politician and say, I understand, I feel your pain. We're worried about the debt crisis. It's going to be a crisis. He said this for a long time. However, PIMCO's Andrew Balls, did you see this story? It was really interesting.
Yeah, not long duration in the U.S., but elsewhere.
Exactly, because of this concern about the deficit becoming an issue. So key question again, when does it matter? Because right now, it seems like it's under control and people talk about the wall of money that just keeps going into bonds.
That's the market story. We promised you updates throughout this morning on the latest in Baltimore as well. So here is the latest, just absolutely stunning pictures to wake up to as the Francis Scott Key Bridge collapses following a ship collision. In the last hour or so, just piecing together what happened here, from Maersk, the shipping company out of Europe, big global container shipping company, saying the ship it had chartered caused the Baltimore Bridge collapse. So that's the latest from Maersk, saying the ship they chartered caused the Baltimore Bridge collapse. That stock has been trading lower ever since we got that headline about an hour ago. And in the last 30 minutes or so, Lisa, we had a news conference with the Baltimore Fire Chief, James Wallace. A couple of headlines coming from that are worth sharing. Still an active search and rescue underway. Could go on for a long time. A large water area, subsurface and deck of ship still to be searched. They've been able to remove 2 people from the water. The latest information is they're looking for upwards of 7 individuals.
There are a number of things. The first thing is a total tragedy for anyone who is involved in this. Just on a larger scale, it raises questions about the infrastructure of the nation, especially if we're talking about air control safety and we're talking about bridges collapsing. I understand they're all one-offs, they're all anecdotes, but at a certain point you have to wonder when this raises questions about updating certain types of security infrastructure that would make the country more secure.
Also, the Baltimore fire chief is talking about they're not able to determine if there's an active fuel spill because of the darkness. So as we get into the later hours of the morning, they're going to be assessing this. And if there's a fuel spill, that's going to add to a lot more issues as well and what's going on in this crisis.
The message coming from Mayor Scott this morning, thoughts with families, and the focus will be on the search and rescue. And I think that all resonates with all of us. Promising you regular updates on this story. We'll get another one in about 10 minutes' time with Yahira. Look out for that. Let's start with the price action just briefly on the S&P 500. Equity futures on the S&P bouncing back by something like 0.4%. Yields a little bit lower by a basis point or two on a 10-year, 422.77. Coming up this hour, Julian Emmanuel of Evercore on whether the rally in stocks is different this time. Israel Strategic Affairs Minister Ron Dermer on growing tensions with the United States. And Megan Robson of BNP Paribas expecting a, quote, credit soft landing. We begin with the top story. Fed officials maintaining a cautious view on rate cuts ahead of a fresh dose of inflation data on Friday. Julian Emmanuel of Evercore ISI writing this. The phrase, it is different this time, is being heard everywhere, especially since the Fed has promised to cut rates from a position where the economy is not slowing. We do think that Friday's core PCE number could surprise to the upside and a cut would get quickly priced out and the market would respond with stock weakness. Julian, I'm pleased to say, is with us for more. Julian, good morning.
Good morning.
Good to see you, sir. In the exuberance zone, can you describe what that zone is and whether it's irrational or not?
It is not irrational, okay, because I think when we as investors think about history, we have to go back to the time where, frankly, having run money during that time, you knew there was irrationality in year 2000. That was 28 times earnings. We are at 23 times earnings now. The S&P, in our view, would have to get a lot closer to 6,000 to get to irrational. However, we are seeing signs of, the wall of worry having been completely dissolved, very aberrant behavior in the options markets, betting on stocks doubling in the course of 3 or 4 days, incredible. Betting on the NASDAQ rallying a further 33% out to June after already rallying 30% since the October low. All of these signs you see short interest being at decade lows. All of these things say that there is a feeling that the market isn't invincible. And when you think about the narrative of the last several months, where we walked back from 6 rate cuts to 3 rate cuts, without the market, pausing for even a moment, you can understand why we're there. We think that the reaction to hotter inflation may be different.
You know what the comeback might be? Just because you found someone playing blackjack doesn't mean we're in Las Vegas, right? You can always find something like that.
You could redefine it.
You can find the gambling going on somewhere. That stuff always exists. What's new about this?
So what's new about this is that this phenomenon known as 0 days to expiration options really, in a lot of ways, is the equivalent of what we saw back in the late 1990s. It was called day trading then. Obviously, it's called high-frequency quantitative trading now. But the speculation that you can really cause to happen every single day. And we saw it in this earnings season, this last earnings season, and we're likely to see it again this earnings season, where you have these stocks that have enormous gaps to the upside and the downside because of the exuberance that really has no precedent in the options market.
Which raises the question, where is the reality check? Where is the gut check? You say it comes from, in some ways, the inflation data. It comes from Fed expectations. It comes from the bond market. What's the trigger, though, at a time where the market is hearing what the Fed is saying? And then some. They're hearing the rosiest picture that the Fed's going to let inflation come down very slowly, but that they will get it under control.
So when you have momentum of this kind of strength, and we have to acknowledge that this is among the most record-setting periods of momentum that we've seen, there tends not to be a discrete trigger. The one thing we would point to is when you think about it, actually the month of April is sort of an outlier in that what you tend to see is sort of momentum reversals. And what we've looked at over the month of March is some of these momentum names have stalled. They haven't reversed, they've stalled. But when you're trying to feed that sort of exuberance, stalling is something that we take note of. And again, with this tendency, turning the page to the second quarter, there is a potential, in our view, of momentum really taking a back seat.
How do some of the retail investors, the traders that use these options contracts that you were talking about, fit into the picture of how this will develop? Do you think that they increase the fragility of markets, or do you think that essentially they're just a feature of the moment that we're in?
Well, no, actually, and we said this when 0 days to expiration options first became, quote unquote, a thing, that we felt very highly convicted that it would suppress volatility. Because if you think about it, the casino is open from 9:30 to 4, and then you cash your chips in, and there's no overnight risk. Okay. And actually, as a professional investor, that gives you opportunities that you might not normally have. Because when you're pushing the action on a day-to-day basis in this way, and you get these gap moves, if you're a disciplined buyer and seller of stocks, you get these opportunities to add to positions, to trim positions that actually increase the alpha and make this the environment that we're in of stock selection is also unlike anything we've seen. But a lot of this is driven by this constant exuberance that we see on the part of the public.
Can you talk to us about opportunities right now then? What are they?
So we continue to think that there's a likelihood of the economy slowing in the second half and into 2025. And when you think about it, some of these more defensive sectors that actually tend to do well in the period from the last hike to the first cut have lagged. They've had idiosyncratic issues, healthcare, consumer staples, really sort of working off the GLP-1 phenomenon. We think there's a lot of value there. And there's also this entire subset of names whose valuations haven't moved out in the way the index has, that still have strong earnings. It's across sectors.
Can we get to healthcare? I'm pleased you brought it up. What am I buying when I buy healthcare? Is it just the GLP-1 thematic story? And some people might point to that as exuberant. What am I buying?
Well, so that's what held the rest of the sector back for the majority of last year. But when you look at it, right, there's this whole notion that we've started to see M&A activity come back because financing conditions have remained as favorable as they have. And that really points to, the future in terms of biotech. Small cap biotech has done pretty well this year. We think there's a broadening. And of course, in this environment where the likelihood is that, with a yield on some of these names, 4, 5, 6%, barbelling into some of the safer names, cash flow generators, makes sense to us as well.
Interesting. Julian, thank you. It's good to see you, as always. Thank you, sir.
Thank you.
Julian Emmanuel there of Evercore in the exuberance zone. Promised you a few times this morning, regular updates on the latest out of Baltimore every 30 minutes or so right here on Bloomberg Television. Here's your latest with your Bloomberg Brief. Here's Yahira Hackers. Hey, Yahira.
Hi, John. We begin with a warning. Some viewers may find these images disturbing. A search and rescue operation is underway in Baltimore after a container ship struck the Francis Scott Key commuter bridge, sending vehicles into the river. Emergency services say 2 people have been removed from the water.
We are still very much in an active search and rescue posture at this point, and we will continue to be for some time. There were likely multiple people on the bridge at the time of the collapse, and that, as a result, multiple people were in the water. We may be looking for upwards of 7 individuals. That's the latest information we have.
In an emailed statement, Maersk saying the container ship Dolly was operating under its charter. The White House says there is no indication of any nefarious intent. A Bloomberg News investigation has found examples of a growing black market for SpaceX's Starlink internet terminals. The access points have been popping up in territories ruled by repressive regimes, including Iran, Sudan, and Yemen, while Ukraine has accused Russian forces of also using the services. Elon Musk says the company isn't knowingly providing the terminals to any of these countries. And LA Dodgers star Shohei Ohtani says he's never bet on sports or used a bookmaker. The Japanese baseball player addressing media for the first time since allegations relating to his friend and interpreter surfaced. Ohtani says he only found out last week his interpreter had a gambling problem and was in debt, and that he never, quote, willfully sent money to a bookmaker. ESPN reported the interpreter racked up $4.5 million in gambling debts with wire transfers sent from Ohtani's bank account to the alleged bookmaker. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, President Biden closing the gap.
It's still March, obviously, and a lot can change. I think there'll be 4 or 5 momentum swings during this campaign, maybe even more.
That conversation up next. The latest poll out of Bloomberg Morning Consult up next. Equities on the S&P 500 positive here by 0.4%. Yields a little bit lower by a single basis point. The 10-year 423.16. Under surveillance this morning, President Biden closing the gap.
It's still March, obviously, and a lot can change. I think there'll be 4 or 5 momentum swings during this campaign, maybe even more. What Biden has going for him, though, is money. Believe it or not, the Democrats and Biden have far more money than the Republicans and Trump, and I think that will make a difference.
It's the latest this morning. President Biden gaining ground in 6 of 7 key swing states this month, according to the latest Bloomberg Morning Consult poll. Biden seeing his biggest gains in Pennsylvania and Wisconsin. The move following the president's State of the Union, which rallied Democrats. Joining us now is Bloomberg's Mario Parker in Washington. Mario, let's start with this story, then we'll move across to the latest out of Baltimore. Can you go through this poll and how it stacks up versus what we've heard in the last few months?
This is, while this poll shows that President Biden continues to trail former President Donald Trump, this is the brightest poll for President Biden so far to date. He's essentially gained ground in some of the crucial blue wall states that that he'll need for November, one of which is Wisconsin, where he's made up ground, covered about 4 percentage points to take a slight lead on former President Trump. Pennsylvania, he's competing there, essentially deadlocked, as well as Michigan. These 3 states are crucial. These are the bedrocks to President Biden's pathway toward the 270 electoral votes that he needs in November.
Mario, the president ended February with $71 million of cash on hand. The former president ended with $33.5 million of cash on hand. Biden has a huge advantage when it comes to money. Where's he putting that money?
That money, Annmarie, is going to those battleground states. And you're seeing the significance of that type of cash advantage right now. President Biden is essentially blitzing the airwaves in those key swing states. About 61% of the money that he has is going on the airwaves there. That's important for, at this point in the campaign cycle, at least the running television ads, right? Sometime deeper into the election cycle, it'll be important for putting people on the ground, knocking on doors, et cetera. This is a good position to be in for President Biden. Again, you're seeing just how he's able to kind of deploy those resources relative to former President Trump.
The other interesting point our poll finds is that actually taxing the rich is resonating among swing state voters. Is this something Biden's going to be leaning into?
Absolutely. You've heard President Biden say time and time again that he won't raise taxes on anyone making below $400,000 per year. Now, one thing as divergent as President Biden and former President Trump's policies are, there is this populist tint, right, that's gone through the political discourse. One of those things is essentially just having the rich pay their fair share, right? So that's one thing that you do see with bipartisan support.
Mario, I'd like to turn to the shocking pictures we all woke up to earlier on this morning, which appeared to show a ship colliding with a bridge in Baltimore. That bridge was the Francis Scott Key Bridge, collapsing in Baltimore following that collision. We've learned a few details in the last hour or so. One detail speaking to where that ship was coming from, chartered by Maersk, Mario. What else have we heard?
Yeah, well, right now, the great news so far is that 2 people have been recovered. One of those folks are in serious condition, but that is at least a bright spot so far, and this sad situation has developed overnight. That bridge, I've traveled across it time and time again, living out here in Washington, D.C. Just remarkable images to see it collapse in the way that it did. We're heading into, there's a couple of implications there. We're heading into Easter weekend, a busy thoroughfare up and down I-95, the East Coast. That'll create some jams there. It's one of the biggest U.S. East Coast ports for light trucks and cars as well. So you'll see some type of economic impact there as well. The White House so far is engaged. They say that there's nothing nefarious at this point.
What can the White House, or what should they be doing, Mario? Is this something you think the president has to give an address about?
Yes, absolutely. I mean, this appears, again, at this point to have been an accident, right, with the ship colliding with a bridge. But we know that infrastructure is one of the key components of President Biden's platform. It's something that he speaks about all the time. He continually boasts about the ability of the U.S. manufacturing to rebuild infrastructure in a quick ways as well. And so, yes, we'll expect to see him there. He's close with Governor Wes Moore. He's one of his Biden's top surrogates on the campaign trail. Of course, Baltimore is right here near D.C. also. So you'll see the president likely say something about this.
Mario, as we do try to recover everybody right now, that is where the focus is in the human story behind this. Going forward, there are going to be a lot of questions about what went wrong, whether this was traffic controllers in the channel that were not up to par, whether it was a miscued kind of communication. Do we have any knowledge at this point what went wrong here and whether it was a vulnerability in the bridge? I mean, how much of an issue is this?
We don't know just yet, so it's tough to speculate at this point as to what happened there, whether it was traffic control, whether it was just some type of mistake on the part of the ship captain and the crew there as well. The mass of that ship hitting, again, that bridge is something that was remarkable, and I think that's kind of what we've seen there.
The immediate focus, as you know, Mario, is going to be on search and rescue. Do we have any idea of the number of people involved, the number of organizations? Can you walk us through the current effort?
Yes, right now, at least so far, the Coast Guard is engaged again, and the great news is essentially that 2 people have been recovered. So you've got Pete Buttigieg, the Department of Transportation Secretary, has said that they'll have the full resources of the federal government. Governor Wes Moore of Maryland has declared a state of emergency to essentially marshal all the resources that state has as well for search and recovery.
Mario, appreciate the update, sir. Thank you very much. Mario Parker there on the latest on that bridge collapse in Baltimore. Lisa, of course, the focus of officials on the ground is going to be on search and rescue. Need to get a better understanding of the disruption caused, the number of ships that need to reroute, the kind of traffic that's going to be caused. Now, you can't use this key location point, this key travel point. And then beyond that, then you start to get into the what went wrong. What happened on this ship? What led to this collision?
And as we get into some of those questions, it really does become reminiscent of some of the other air traffic control issues and this whole focus on an aging infrastructure that a lot of people say hasn't been invested in. It reminds me of the ships and the shipbuilding that we've been hearing about, and the fact that the cranes that we have are imported from China because we don't build them.
Well, remember the supply bottleneck crisis. I was at this port with President Biden when he was talking about this. This is a massive port, incredibly important to the United States, especially the East Coast. And you're just going to see a huge, to Mario's point, Governor Wes Moore talking about a state of emergency. It's going to be a massive interagency response on the state and the federal level.
Another update coming to you in the next 20 minutes or so look out for that. Coming up on this programme, the Israeli Prime Minister Benjamin Netanyahu cancelling a trip to the United States for senior officials. We'll be catching up with one of those officials. Ron Dermer is going to be joining us next. Lisa, plenty of questions on this one, because as far as the US is concerned, nothing's changed. Why did you cancel this trip?
They might say that nothing has changed. The tone has shifted, though. And I think that anybody who doesn't see that would be a little bit disingenuous, because there has been a clear pushback to Israel's approach and sort of a question of the incursion in Rafah. To me, the question that I have is, at this point, how much are you depending on the U.S. for weapons, and how much do you really feel emboldened to pull away from the U.S. at a time that you rely on them?
It also could be international embarrassment, right? Netanyahu's office came out and said, we need you to veto this Security Council resolution when it comes up. And the United States said no. They didn't vote for it. They abstained. But this is something that Netanyahu says, well, then you know what? My officials are not going to be going to Washington. We should note, though, it was a suspended trip. So potentially maybe next week or the following weeks, they'll be coming to Washington.
That conversation up next. Sneak peek at a price action. Equity futures on the S&P 500 positive here by 0.4%. The S&P bouncing back from some very mild losses yesterday. Yields are lower this morning by a single basis point. The 10-year 4.2356. New price target over at Morgan Stanley in the last few weeks. Looking for $90 on Brent crude. WTI this morning, $82.11. We're positive there by 0.2%. From New York City, this is Bloomberg. Stocks bouncing back on the S&P 500, up 1/3%, up 0.4% on the Nasdaq. The Russell outperforming once again. We saw that on Fed Day, didn't we? Up 0.75% on the Russell 2000. In the bond market, 2-year, 10-year, 30-year, and a warning from Larry Fink of BlackRock. Yields 4.2356, down a basis point this morning, down 3 on a 2-year to 4.5951. The warning, Lisa, the warning is a snowballing debt pile in the United States of America that needs to be addressed by the boomers, apparently.
I'm wondering if you're trolling Larry Fink a little bit. You're saying there was a warning from him. Look at those yields. They're lower by 3 basis points. But basically, we've been talking about this warning about the debt overhang and the deficit in the United States, and yet continually yields go lower despite some of these concerns being out there. So, again, when does that come to the fore, given the fact that, yes, this has been something we've been talking about, people talking about a Liz Truss moment, but,
well, the
Financial Times.
On the front page of the FT.
Exactly. But to me, it's just going forward, when does it actually get reflected in yields?
It's an odd situation. There's a team over at JP Morgan. I remember the line. It was something like the boiling of the frog, right? The boiling of the frog, except the frog knows it's being boiled. That's kind of what's bizarre about this situation, right? Because we all know that it exists. We all know the trajectory is unsustainable. And here we are talking about the same thing still. What we don't know is where the line in the sand actually is. It's kind of like the frog is aware that the water's getting hotter, but ultimately he's not going to get out.
The frog being boiled, in my opinion, and based on what Larry McDonald just said, is the dollar. And ultimately, as long as the dollar is the reserve currency, the U.S. will have, in your words, the privilege to act recklessly. If you do start to get a weaker dollar, and you do start to say, just slowly, people pulling away from it, then maybe things could change.
Do you remember when we caught up with President Kashkari and asked him about this topic, and he said, want to kind of push back to it. Yes, yields have risen, and there might be concerns about supply, but it's hard to reconcile that with the dollar strength that we saw in the same period.
Which is the reason why people say game on, and yields continue to drop.
That's the story there. Under surveillance this morning, a top story for you. Boeing shares rising in the pre-market, adding to yesterday's gains. The plane maker plotting a path forward without CEO Dave Calhoun. Dave Calhoun announcing he will step down at the end of the year after 3 of Boeing's largest U.S. customers reportedly asked the company's directors for a meeting to air concerns without the CEO present. AMH, you picked up on this story almost immediately yesterday. This is where things changed and changed quickly.
Yeah, because why would you go on a listening tour without the head of the company? It's because you want to complain about that individual. What I find interesting, though, is that they're giving him a long runway to the end of the year, which says to me they're trying to sort out a serious succession plan. We heard from Bloomberg Intelligence yesterday, which said this is someone that just doesn't need to know the financials. This needs to have an engineering mind. And it's a chance, then, I think, for Boeing to reset.
That's the latest on Boeing. Here's the latest on China. US CEOs on a visit to China, extending their stay after receiving a last-minute invitation to a meeting with one of the country's top leaders. The CEOs of Pfizer, FedEx and Amway are among those visiting for the China Development Forum, which ended yesterday. Bloomberg reporting the meeting is expected to be with President Xi, even though his name doesn't appear on any invitations. I guess it's just one of those things, Brammer, where you sort of know.
If you know, you know.
They're just sort of smoke signals coming out
right.
and have a Xi kind of feeling. At this point, I'm curious to see what they actually hear. Is it really the welcome carpet? Is it a more nuanced message? This just highlights how intertwined the two economies are, the U.S. and China, regardless of all of the noise. And U.S. corporate executives are pretty much on the forefront of that. Do they walk away? Do they pull back? Or do they double down, as we've heard a number of them, Qualcomm including, do, because this is the world's second biggest economy?
That's going to be one to watch in the next 24 hours or so. One to watch right now. Israel Prime Minister Benjamin Netanyahu's office cancelling a planned visit by senior aides to Washington. The decision coming after the U.S. abstained from voting a UN resolution demanding an immediate ceasefire in Gaza. One of the aides scheduled to visit the U.S. was Ron Dermer, the Israel Strategic Affairs Minister. He joins us now from Jerusalem. Minister, wonderful to catch up with you once again, sir. I want to begin our conversation, if we can, with a quote from John Kirby, the spokesperson for the U.S. National Security Council. And, Minister, this is what he had to say. There's no reason for this to be seen as some sort of escalation. Nothing has changed about our policy, nothing. We still want to see a ceasefire. We still want to get hostages out. Minister, can we just begin with that line coming from the administration? What exactly do you believe has changed as they turn around and say nothing has?
Well, I believe their policy that has been pretty consistent, John, since the beginning of the war about 6 months ago, was to not accept a ceasefire that would be unconditional, and it would have to be connected to an agreement to release hostages. Unfortunately, in this text that was passed, those two issues were separated for the first time. In fact, 5 days before, there was a resolution that the United States put forward that was vetoed by China and Russia. And one of the reasons why they vetoed it is because it connected those two issues. And if you look at the text, and everyone can go see it on the UN website, and you look at the resolution 5 days ago, and you look at the resolution that passed yesterday, you'll see a huge difference. And unfortunately, that's a change in U.S. policy. Now, I'm glad to hear that John Kirby said it's not a change in U.S. policy, and I hope that they will continue to connect those two issues. But that's not the text of the resolution, and that's why Hamas celebrated the resolution and welcomed it. That's why Iran welcomed it. Believe me, any resolution by the UN Security Council that Hamas welcomes is not a good resolution for Israel.
Minister, you were due to travel yesterday evening. Could you share with us what you said to the administration directly after that decision?
Well, I spoke to them. I haven't spoken to them after that decision. I spoke to them before that decision. When we first learned about which direction this was going, I did on, I think it was Sunday night. And when I heard what was happening, I said, look, you're going to have, it's the wrong message at the wrong time. I explained to you why it was the wrong message, because it's not connecting the issue of a ceasefire with the return of the hostages. And why is it such bad timing? Because we had negotiators in Doha trying to get an agreement to release hostages. And it's not surprising that Hamas decided to reject the latest proposal that was put forward by the Americans. Because why should they not reject it? They think they're going to get a ceasefire without giving up the hostages, because that's what the resolution said. And I understand and I appreciate that the United States has said that's not our policy, but that's not the text of the resolution. And that's the problem. And I told them before, if this would be the case, I would find it very difficult to believe that the prime minister would send a delegation to Washington. Why? Because the purpose of us going to Washington was to discuss and to actually listen to American ideas of how we should go into Rafah, the other ideas that they said they had, without a major military operation in Rafah. What message, John, is it going to send to Hamas that the day after that the Americans separate these two issues and say, you know what, you can have a ceasefire without a hostage negotiations, and then the United States is presenting its proposal how we should not go into Rafah? That's a real big problem, and that's why the prime minister made the right decision to stop the delegation, which I was leading, to go to Washington.
Okay, so this trip was suspended. Is there any plans for you to come to Washington then in the future?
I don't know. We'll have to discuss it with the U.S. administration. We haven't had those discussions yet. I think the context here was particularly problematic. Obviously, the U.S. has ideas, and I'm sure they'll share it with us. I don't know if it'll be in a delegation in Washington's people coming here, us speaking over the phone, but they have ideas that they want to present to us. The president asked the prime minister of Israel to send the delegation so that we can hear their ideas. We have our defense minister in Washington now. I'm sure he's discussing this with them. But I think the timing was particularly problematic because of the message that this UN Security Council resolution was sending. It was a very, very bad message, both for the hostage negotiations, and also we have to be very clear with Hamas. We have to be very clear that we're going to fight this war until the end. And the last thing we want them to believe that the international pressure on Israel will get us to simply not finish the war. That's not going to happen. Now, I don't decide what the United States will do or won't do. They're a sovereign government. They'll have to make their own decisions. But Israel has to make clear to Hamas that we intend to fight this fight till the very end. And hopefully that pressure, their understanding that we're going to fight this to the end, will enable us to get to a hostage deal.
Well, the Israeli defense minister, as you say, is in Washington. We have Benjamin Netanyahu, the prime minister, approving a Rafah operation. But the Israeli defense minister said he had a good meeting with officials in Washington. Did anyone convince anyone on either side to change?
Well, look, we've been in discussions with the U.S. administration for a long time. The initial U.S. policy was essentially not that they're against an operation in Rafah full stop. What they said initially was that Israel has to make efforts to get the civilians out of harm's way and to ensure that humanitarian assistance can get to them. And guess what? We agree. And we've been working on a plan to get the civilians out of harm's way and to ramp up humanitarian assistance to them. So this is something where the two governments should be able to get to common ground and should be able to get on the same page. Now, if the position of the United States is there should not be a major military operation in Gaza, then we're not going to be on the same page because we have to go in to Rafah. We have to finish the job. We have to take care of these 4 battalions. We can't leave 20% or 25% of the Hamas force in Gaza so they can simply reorganize and come back. And Israel's major military operations actually have enabled us to do much smaller operations and achieve great success. Look at what happened in Shifa Hospital. I don't know if you're following that in the northern part of the Gaza Strip. We were there a few months ago and we did a major operation. Just now we went back last week and we have done one of the most successful operations in Shifa Hospital in our history. Nearly 200 terrorists were killed there. Over 800 terrorists were captured, and there have been 0 civilian casualties. In fact, there have been more Israeli soldiers, too, who have died in that operation than civilian casualties. Why can we do that? And I think this is a very important point for your viewers to understand. Because once you do the major military operations, once you crush these battalions and defeat them, Israel has to come in with a much smaller force, much more careful military operations, and achieve great success. That's why it's so important for us to go to Rafah and to finish the job.
You keep saying fight this until the end. People have already talked about when you have people living in dire situations, people who've seen their loved ones being killed, that breeds extremist type of behavior. And you're already seeing that in certain places, that even if you kill Hamas, something else will come in its place because there isn't leadership and there isn't a sense of what the future is. How do you counter those types of discussions? How do you say there is an end that you have in sight?
Well, first of all, understand what we're trying to achieve. We're trying to destroy Hamas's military in Gaza. They're not a terror organization in Gaza. They're a military terror organization in Gaza. And we have to crush their military, and it's divided up into battalions. And we're doing that, I think, very well. But what you just said about it breeds extremism, I'd ask you, do you think that the action of the United States against the Nazis in Germany, do you think that bred extremism among Germans? Do you think the actions of the United States in Japan bred extremism? I mean, you were smart enough to, first of all, finish the job and win the war, and you demanded unconditional surrender to achieve it. And then you were smart enough to be magnanimous in victory and provide a different path for the future.
Well,
but you have to finish the job. If you do not finish the job, the situation will actually be worse. You have to finish the job, defeat them, and then you can talk about a day after. Then we can talk about how we can expand peace in the region, what we should do in the long-term prospects of Israelis and Palestinians. But there will be no day after Hamas if Hamas is still there. That's why we have to finish the job.
I guess that one of the key questions that has been kind of hanging over this is we don't have a clear sense of how you provide that type of structure in any way when you don't have that being provided with respect to who's going to be the leader, with respect to who's going to provide the financing, with respect to even whether there'll be 2 states and what that will look like with certain land in the West Bank being seized. So how do you address those kinds of questions that do need to be put into place before you finish the job?
I don't believe they have to be put in place before you finish the job. In fact, I think just the opposite. I think if you try to put that in place now, you could actually undermine the effort to get to a real good day after plan afterwards. Because first, everybody has to understand that Hamas in Gaza is finished. Until they understand that, no one will step forward. So you're going to actually have a plan that's going to be stillborn. The second you win, that's the time when the international community, obviously led by the United States, Israel, Arab partners in the region have to come in and say, okay, what do we do now? Now Hamas is defeated in Gaza. What is the next step? To think that anyone is going to emerge now when you have 4 terrorist battalions of Hamas in Gaza, maybe around 15,000 terrorists fighting there, and that somebody is going to step forward, kidding themselves. We saw what happened in the northern part of the Gaza Strip when we try to work with local actors. Hamas took them out and executed them. That's what's going to happen until we finish the job. That's why I think it is in the interest of all countries who not only are interested in Israel's security, but interested in a better future for the Palestinians, to get Israel to finish the job as quickly as possible so we can move on to a day after. And the truth is, we have real partners in the region for that day after. I think the Saudis are a partner. I think the Emiratis are a partner. I think they are starting, and they've worked to de-radicalize their own societies. I think we need to look for them and to their leadership to see what we can do in a day after, and then we can talk about all of those political issues. But first, we have to get to a day after. We have to finish the job. You cannot leave that force in Gaza. It would be like, as one Israeli minister said, Minister Gantz, he said it would be like fighting 80% of a fire, leaving 20% of the fire, and simply hoping that it's not going to come back. Of course it'll come back. We have to douse these flames, and then we can talk about the day after.
Minister, I know we only have a few minutes left with you. I had a few direct questions to work through with you, if I may. The Vice President of the United States spoke over the weekend. Here's a quote from her. Any major military operation in Rafah would be a huge mistake. I'm not trying to understand from your side why you think that's not a mistake. I'm trying to understand now what the consequences would be if you cross that perceived red line now. Have they communicated what the consequences would be for Israel and the relationship between you and the United States? Have you heard anything whatsoever?
No, they haven't communicated that with us, but I can tell you, John, what the consequences will be if we don't go in and finish the job. It'll be that October 7th will happen again and again and again. People in the United States have to understand that the people of Israel see what happened on October 7th as an existential threat to the country. And I'll explain to you what I mean. It's not because I think Hamas can destroy the state of Israel. They cannot. But if we do not destroy the terror organization that did that on October 7th, if we do not take them out as a military organization in Gaza, then I truly believe that this country has no future, because all the buzzards who are circling around Israel and are looking to see what's going to happen to Hamas after they perpetrated that attack, they have to understand that Hamas as a terror organization in Gaza as a military is finished. You know, there are American officials. This happened a couple months ago. A senior official came and he said, you know, Hamas is an idea and you can't destroy an idea. And I countered by saying, you know, Nazism is an idea. And there are Nazis in Charlottesville walking around with tiki torches that they bought at Bed Bath & Beyond, but they don't have a state called Germany. ISIS is an idea. And there are people who follow ISIS. You saw the attack in Moscow just a few days ago. And there are black flags that are in bedrooms, probably not just in the Middle East, but in Europe and even places in the United States. But they don't have a state. They don't control the territory of a caliphate between Iraq and Syria. It is one thing to deal with a terror organization. It's another thing to deal with a military that is a terror group. That's a total different story, and we're going to dismantle Hamas's military regime in Gaza. It's going to happen. And I would like to have the United States by our side. They've been there for the last 5 months, 5.5 months, with critical support out of the gate. The moral clarity of the president calling Hamas sheer evil, worse than ISIS. The fact that they sent aircraft carriers here. The fact that the president himself visited 10 days into the war when we could have had an escalation in the northern part with Hezbollah. So they've done very important things. And what I have implored them is to stand with Israel until the end, because we're going to achieve this victory. And I think it's not only in Israel's interest to achieve that victory. I think it's in America's interest to achieve that victory, because they've been part of this they've been part of this victory up until now. And now we're down the home stretch. I think stand with us. Let us finish the job. And let's get to a day after where we can actually have a real peace process that can give hope, not just to Israelis, but also to Palestinians.
Minister, this is a conversation that you and I will have to continue that requires a heck of a lot more time than the 10 minutes we just had. Ron Dermer, thank you, sir, for joining us today, the Israel Strategic Affairs Minister. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. A massive search and rescue operation is underway in Baltimore this morning after a container ship struck the Key commuter bridge in the early hours. Emergency services say 2 people have been removed from the water. 1 was seriously injured.
We are still very much in an active search and rescue posture at this point. and we will continue to be for some time. There were likely multiple people on the bridge at the time of the collapse, and that as a result, multiple people were in the water. We may be looking for upwards of 7 individuals. That's the latest information we have.
Maryland's Governor Wes Moore has declared a state of emergency. Traffic has been suspended around the area, with motorists advised to avoid the I-695 interstate. In a statement earlier this morning, Maersk said the container ship Dolly was operating under its charter. Baltimore ship traffic through the port has also been suspended as the rescue and cleanup operations continue. And Donald Trump is now among the world's 500 richest people. Trump's social media company wrapping up a multi-year merger process, giving the former president billions of dollars worth of shares. At the same time, a judge slashing the amount of a bond payment Trump owed by several $100 million. Trump's fortune had previously peaked at around $3.1 billion. His net worth now climbs to a new high of $6.5 billion. That's your Bloomberg Brief. John?
Yahara, thank you. The opening bell about 1 hour and 40 minutes away. Equity futures right now on the S&P 500. Near session highs, up about 0.33% on the S&P. Under surveillance this morning, tighter for longer.
Neutral for a while, but between 425, 450, we have been adding duration. We've been slowly adding to that duration position. Clearly, spreads are extremely tight, but one has to look for pockets of value wherever we can find them. Unusually and terribly tight, I'd say right now, on most of credit spreads.
Here's the latest this morning. US corporate bond spreads are the tightest level in roughly 2 years, with a chance of tightening further as the Fed signals it's on track to start cutting rates. Megan Robson of BNP Paribas expecting, quote, a credit soft landing, 2 to 3 rate cuts providing some relief for financing costs, while rates will still be high enough to encourage yield buying from investors. Megan, I'm pleased to say, is with us around the table. Megan, can you describe that? And good morning. Describe what is a credit soft landing.
Well, thank you for having me. So credit soft landing to us means we won't have a default or downgrade cycle and essentially skip the downturn phase of the cycle. And as you just described, we are seeing signals of a credit soft landing play out. And I think the Fed messaging last week, which we interpreted as very dovish, really reinforced that sentiment in the market that we can still get 3 rate cuts despite some of the hotter inflation data, which will continue to support credit markets both on a fundamental basis and on technicals.
Are we priced for a credit soft landing, or are we priced for a credit nirvana?
Well, with spreads at the tights, a lot of optimism is certainly priced in. We do think we've overshot our spread targets for the year, but we're relatively close to where those are. I think in April we are expecting the technicals to be very supportive, so potentially can grind further from here. But you know, the argument to buy credit from this point is not spread upside. It's really more of a carry story where you're buying credit to earn yield.
Which creates a really interesting question. Do you go into the higher quality debt that has pretty narrow spreads and don't get as much all-in yield? Or do you go to some of the riskier debt where all of a sudden companies might have less of a perfect soft landing, given that they haven't yet really faced refinancing costs that are much higher than where they used to be? Is that the correct trade, to go down and to go into some of these riskier companies?
I think it really depends on the market. So in investment grade, we do like reaching into lower quality. So we have an overweight to triple Bs. Even though triple Bs have already outperformed, we think that you're still getting that pickup in carry and spread, and fundamentals look good. Within the high yield market, we think you have to be much more selective. So even though spreads are at 2-year tights, underneath the surface, you can see distressed ratio, or the number of bonds trading over 1,000 basis points, has climbed higher. And it's unusually high for this type of environment where people are so optimistic. So I think that tells you are seeing some of these issuers, lower quality, struggle.
So earlier this week, or actually last week, Bob Michael of JP Morgan Asset Management came on the show and said he's really changing his tune when it comes to investment grade debt, but also more broadly with respect to private credit and how much that's been sort of a stabilizer for the overall U.S. credit market. Do you agree that this is actually a source of stability, not necessarily a source of potential hidden risks that are out there that are sort of pocketing the landscape?
So I think private credit was a source of stability last year when syndicated public markets were closed, and it provided an avenue for some issuers that couldn't access high yield, traditional loans that could actually borrow. This year, I think the story has changed where there's such a competition for capital that you really have started to see the competition between public markets and private markets drive credit spreads tighter, start to make covenants a little bit less strong. And unlike the past when you saw bilateral loans between one private lender and one issuer, now you're seeing it look much more similar to public markets where there's lending groups, including private and public lenders. And I think over time, you're going to see a convergence of those two markets, and it does create a bit of froth with pushing spreads tighter.
Megan, just getting some breaking news, so just got to run briefly. Megan Robson there of BNP Paribas. The latest from ABC News this morning on the major Baltimore bridge collapse. Getting some more details for you. If you are just tuning in, waking up to some tragic images coming out of Baltimore. The collapse of the Francis Scott Key Bridge following a collision with a ship. Learning more details in the last few hours about the nature of this collision. This from ABC. I'm quoting them directly. An unclassified cybersecurity and infrastructure security agency report said the container ship Dali lost propulsion as it was leaving port and warned Maryland officials of a possible collision. The crew notified officials that they had lost control. This report goes on to say that the vessel notified MD Department of Transportation, MDOT, that they had lost control of the vessel and a collision with the bridge was possible. The vessel then struck the bridge, causing a complete collapse. Just getting a little bit more colour, AMH, in the last minute or so.
Yep, and there's reports also talking about the fact how this waterway into and out of the port has been closed. There's no other route into the port. Second biggest port in the mid-Atlantic. But ABC, looking at this unclassified cybersecurity infrastructure security agency, starts to show sort of the story of what went wrong. They actually alerted Maryland officials that this collision could possibly happen and that they actually lost control of this vessel.
Lisa, just getting more details in the last 5 minutes or so.
Yeah, I'm looking at this. It was 1:30 a.m., which is the one silverish or not terrible lighting because there were fewer people that were on the bridge. But right now, the idea that there was a warning that they had lost propulsion, that they could potentially hit the bridge, it raises a lot of questions. What could have been done? Is this precedented? How do you just lose propulsion? How is this something that gets checked or not before leaving the dock? A lot of questions remain.
The latest from the White House, the president has been briefed. Biden to get updates on the bridge throughout today. More updates from us here at Bloomberg Television around about every 30 minutes or so. Coming up on this programme, Peter Chi of Academy, Vijay Rakesh of Mizuho, Andrew Honhorst of Citi, and Robert Crandall, the former American Airlines CEO, breaking down his experience with Boeing, ultimately what changed in the last decade or so, and the pressure from airlines to make a change at the top of the company in the last week or so. That's the stage set for the next hour on Bloomberg Surveillance. Here's the price action for you on the S&P 500. Equity futures positive by 0.4%. Yields going nowhere. The 10-year 424.15. In foreign exchange, the euro just a little stronger against the dollar. Euro dollar 108.58.
That inflation really comes down even slower than I think it'll come down. I'm not anticipating a reacceleration.
We really don't see prices moving much higher than where they are today.
The economy is still showing plenty of signs that inflation is coming down.
The inflation upside surprises that we've seen in the realized data will be fleeting.
We're very reliant on this immaculate disinflation continuing.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance, the latest overnight, waking up to some stunningly tragic pictures coming out of Baltimore. The Francis Scott Key Bridge collapsing following a ship collision. I want to do two things and focus, first of all, on the search and rescue effort, and then we can talk about what went wrong. We heard from the Baltimore Fire Chief James Wallace in the last 90 minutes or so, indicating that the active search and rescue would be ongoing for a long time. This is a large water area, subsurface, and the deck of the ship involved still needed to be searched. They were able to remove 2 people from the water. The latest information is they're looking for upwards of 7 individuals. Naturally, when you see images like this, you'll be wondering what went wrong. So first of all, we heard earlier on this morning from Maersk that the ship it had chartered caused the bridge collapse. And you can see this in the image that we received, colliding with the bridge and leading to its collapse. This is what we've learned in the last 15 minutes or so. This came from the team over at ABC, so I'll quote them directly for you. An unclassified cybersecurity and infrastructure security agency report said the container ship Dali lost propulsion, Lisa, as it was leaving the port, and warned officials of a possible collision.
There are a lot more questions that we will be investigating. This, to me, raises also a concern about what the inspection process is like. This ship was just starting a 27-day journey to Sri Lanka. This was the beginning of a long journey. There also are questions now about what this means for one of the busiest ports on the East Coast and whether this does kind of create delays on a whole host of fronts. And honestly, the region is really dependent, actually, on this waterway.
Absolutely. It is a huge port. It's a very important waterway. I was there actually with Biden when he wanted to talk about not just infrastructure, but also some of the supply chain hiccups we were seeing coming out of the pandemic. The president has been briefed on the matter and the collapse of this bridge, the ongoing search and rescue efforts. He'll continue to be briefed throughout the day and receive these updates. We heard earlier on that the White House did not see anything nefarious, Jonathan, when it comes to this vessel hitting the bridge. But clearly you're going to see a huge interagency response. We heard that as well from Governor Westmore of Maryland. When
we get more details for you, more headlines, we'll share them with you immediately, and expect regular updates in this hour, roughly every 25 minutes or so. Equities right now on the S&P 500 as we count you down to the opening bell, shaping up as follows. About 87 minutes away from the opening bell. Equity futures are positive by 0.4%. Yields are just a touch lower, down almost a basis point on a 10-year, 423.75. In foreign exchange, the dollar a touch weaker, euro a little stronger, 108.57 on that currency pair. Coming up this hour, Peter Cheer of Academy Securities on why he thinks stocks are behaving like stonks. He can explain that. Citi's Andrew Hollenhorst looking ahead to Friday's inflation data. And former American Airlines CEO Bob Crandall on what's next for Boeing. We begin with our top story in the market. Investors on hold ahead of more data that could show whether the rally has gone too far. Peter Cheer of Academy Securities saying the market is trading like a meme stock, writing this: I was wrong on how much we could bounce last week on apparent global central bank easing. We seem to whip around 1% like it's nothing. It is like trying, as you can, to seem really smart for a day or two, then really stupid for less of an apparent reason. Peter, I'm pleased to say, joins us now. Pete, good morning to you.
Yeah, good morning.
I think I remember you saying clearly that there was more chance of a 10% drop than there was a 5% rally. Clearly that wasn't right. Why has this market been so difficult to read from your perspective?
It feels like there's very little liquidity. So you watch during the course of the day and you see kind of these sharp declines, sharp rallies on, I think, very little volume. So I think that's made it very difficult. We've come to an age where it's clearly not meme stocks, but you have some of these very large market cap stocks trading quite volatile. And now you actually have a reasonably large 2x leveraged ETF on a single stock, which I've never understood why we would need something like that. So I think that's just amplifying these moves, making it incredibly difficult.
I'm guessing that stock is Nvidia.
It is.
Yeah, based on the performance we've seen, I can see why some people might want to lever up. Not extrapolating out, all of that stuff, history, you know what I'm saying. Anyway, Pete, I want to get your thoughts on this. Rate cuts, not a prerequisite for this market rally, clearly, based on the evidence of the first quarter of 24. Why is that going to change anytime soon?
I think it all comes down that we rallied through the rise in rates because the economy was doing well. So it's all been about the economy, and ultimately, really, it's all been about AI. It's the AI adoption. The AI companies have driven this, right? We don't have a Mag 7. We've got a couple stocks really driving it. We've started to see a little bit more of a broadening out, but I'm concerned we're at kind of peak AI in this cycle, not in terms of adoption, but in terms of is it really delivering? I signed on to something yesterday and they've changed my search to AI. I used to hit Control F and could find things easily. I couldn't figure out how to do it with the AI. I saw a toothbrush that now has AI. So everything's kind of put this AI label on stuff. And it feels a lot right now where we were at peak metaverse. I think AI is much more serious. It's going to last much longer. It's a real thing. But it doesn't mean we can't have peaked right now.
I love that, this idea of a malfunctioning toothbrush and with an AI label. There is this issue, though, that the leading economic indicators of the Conference Board have actually turned positive for the first time in something like 25, 26 months. This is unusual and typically a sign of strength. How do you fight signs of true economic strength with this idea that the market is somehow divorced and already priced for something else?
Well, I think leading economic indicators have had it wrong for quite a while. So they were showing declines. And to me, they're a little bit too tied to financial conditions, to equities. So when equities go up, it tends to drive that. So I'm looking much more what we're seeing in the job market. There, it's been a little bit less of a clear-cut story, right? We're a little bit more declines. So we'll learn a lot next week when we get job numbers and see how that's playing out. So the consumer, again, seems a little bit stretched. All of a sudden, we've gone through consumer credit was fine to it's back above trend. You're seeing delinquency still low, but now creeping back to more normal.
You said there's very little liquidity, and I want to challenge that because a lot of people have come on and talked about the wall of money and how there's just so much money that it's hard to bet against a momentum trade that has been really, in some ways, unprecedented. Where are you seeing a lack of liquidity at a time where this market seems flush with cash?
So what I look for is that intraday kind of trading liquidity, right? When you're having these very sharp and steep declines, and you look at how often, right, we gap up or we gap down, which tells me there's no true depth of liquidity. What we have, we've been referring to it as faux liquidity, or this kind of shark and minnow liquidity, where it looks really active and you can trade a lot, but if someone big comes through with a trade, it immediately moves. So it strikes me that there just isn't a true depth of liquidity. Everyone's just kind of day trading around, which kind of fits with, we've seen the options trading is now outpaced stock trading. You've got the 0-day expiration. So to me, everything is much more a trading environment than a pure liquidity environment.
So what are you advocating for currently?
I want downside protection. I feel that we had the 3% move up, so we didn't quite get to the 5% last week. I feel that we're still much more susceptible to a very rapid 10% decline than another jump up. But definitely, unfortunately, kind of following suit with the trend, looking a little bit more to options. It's very difficult to trade this market, so you're looking at shorter dated options to try and express this view where you protect yourself against a large move.
I want to think about potential catalysts. Is that just the market falling on its own weight? What is the potential catalyst? Because at the moment, at least, for the first 3 months of this year, it hasn't been interest rates.
No, and I think my big concern is really it's going to be about China. And even yesterday, we had a bit of negative news when China was banning a couple of chips companies from selling chips into China. I think what we are going to see over the course of this year, and we've already seen some of it, is China is going to try and repress sales of Western brands into China so that they can bump up their own brands. We've seen that. Some of it's been kind of poo-pooed as, well, it's just China's economy slowing, so that's why they're not buying as many phones or computers or cars. I think it's much more of a pattern that we're seeing from China. And then you start looking at what they're trying to do in terms of selling their brands, not just domestically, but globally. I think France went after Shine, which is another company. Temu's out there. So I think that's going to be the real pressure, is it's going to force U.S. companies to, one, have fewer sales in China, possibly fewer sales in emerging markets, and maybe compete on price, which just isn't great for current valuations.
But made in China, does that resonate to other markets?
So we've been calling it made by China. So if you think everything was always made by China, right? We took our products, had them manufactured in China, and then we sold them. Now China's trying to sell their own brands. And you would think, no, but you go Israel, I believe, BYD is the second most popular EV there. They're starting to sell that. Huawei is everywhere. So they've had some degree of success. And as you start looking at Shine and Temu, you realize at some level price matters.
Well, just taking a step back and sort of pulling this all together, there's a question of what the catalyst will be for some sort of reality check on markets. And it goes to this increasing division between the U.S. and China with this question of how much can the U.S. really look inward, create more industrialization within the country at a time where it's clearly lacking a lot of investment. How much spending capacity does the U.S. have before we start to see it reflected with higher bond yields?
One, I think that's coming, right? We go through the deficit. And then I think back to your question about this kind of ongoing friction, I would say where I get a little bit of disconnect when we talk to corporations, I think corporations are still trying to figure out, okay, how do we take advantage of selling into China? How do we work with China? And it's definitely nowhere close to what it was pre this. But when I talk to, Academy's got 18 retired generals and admirals who serve as our geopolitical intelligence group. When I'm talking to them, they're all about China right now. And if you just look at CISA put out something on living off the land in this Volt Typhoon, which is supposedly critical infrastructure, but they're specifically targeting the People's Republic of China, the Communist Party. They're saying that. So I think D.C., what's going on there is such heightened awareness of this friction and ongoing battle with China that it hasn't fed to corporations yet, but that will come out, I think.
How do you think that's going to come out? What do you think that looks like?
I think we get more and more tit-for-tat sort of policies where, well, you can't send your semiconductors here. Well, then you can't send them here. You can't do this. And I think that's the way we're headed. And at the same time, we're going to see more and more pressure, I think, from China on their, the countries that they have big trade deficits to push their brands. And I think that's going to be the weak spot is emerging markets countries who've been selling a lot of commodities to China have these trade surpluses. I think that's the back door where China really starts aggressively selling their brands and has a great degree of success.
So last time around, and I know this is on Lisa's mind, last time around we did this, there were these warnings of runaway inflation. Didn't happen. Now I hear the same warnings again. Is it different this time?
Yeah, I'm not particularly concerned about runaway inflation. I think we've seen peak in goods inflation kind of was quick. It's slowing down on the services side. It was just a longer kind of COVID bump that's taking longer to play out. I think there's inflationary pressure. We've got some geopolitical risk out there. I think Iranian oil is, a potential target where that would cause oil to price up. I do think as we kind of do this reshoring, that's going to be inflationary.
Former president, 60% tariffs, gets a second term. What does it mean?
I think that fits with this whole battle. And I go back on this. I remember when the President Trump at the time put out the tariffs, a lot of economists were against that, said it was the worst thing ever, starting a trade war. Our position at the time had been that we'd been in a trade war for 20 years and just not fired a bullet. And ironically, not one of those tariffs has been taken off, and some additional things have been going on. So I think if you take away the bipartisanship or the partisanship and go to what's national security, at national security, both parties, I think, are now very fixated on China and very concerned about where they're headed technology and what they can do to us. And that's going to drive policy no matter who wins the election.
Pete, this was great. Just fantastic to break down some of these issues. Lisa, we've been talking about this for a number of months now. What's interesting is when you have this conversation with an equity strategist and you say to him, how vulnerable are multinationals? How difficult is life going to be? Kind of, no. Everything's going to be, it'll be okay. They'll work through these issues. Keep going back to the same point. If that's the world they've got to live in, think about the world they have lived in for the last 20, 30 years. It's been uninterrupted globalization. They've been able to have progressive views at home in America. They've been able to entertain regressive views abroad in places like China and been able to sell products in both countries. Now you're having a cultural collision at home, not just abroad. Then you've got the extra issues of tariffs, etc. On top of that, China seems to be much more interested in domestic brands, and that patriotism that's come through the Chinese consumer is new in the last 10 years as well. I would say it's far more difficult now than it once was.
Which is interesting that today, or tomorrow rather, we're going to see the CEOs meet with Xi Jinping. How different is that conversation at this moment when it seems like that has to be on their radar? We saw yesterday AMD and Intel shares falling as a result of the potential restrictions of their use in Chinese government utilities.
Pete, I know you want to find a word. Multinationals have had it their own way for a long, long time. It doesn't feel like that anymore.
No, and I would say two things. One, we're ignoring the fact that Huawei put out a phone that has a 7-nanometer chip, despite the fact they're not supposed to have 10 nanometers. No one seems to want to dig into that. Why? Because we don't want to find out what the answer is. That, to me, is a danger. And then the other side, the one thing I think corporations are talking about more and more, even before this tragic event today, is global shipping is no longer taken as a granted. I think when you are making business plans, you counted, okay, here's my shipping and here's a cost. And people are getting very concerned about global shipping. I think people are getting concerned about infrastructure. That's something that's going to have to be addressed. And again, I do think that pulls away from globalization and more to this reshoring, working with Mexico, working with South America.
Certainly learning that again this morning. Pete, good to see you. Peter Cheer of Academy Securities. On that note, let's get you the latest update out of Baltimore. Here's your Bloomberg Brief with Yahira Hackers. Hey, Yahira.
Hi, John. A massive search and rescue operation is underway in Baltimore after a container ship struck the Key commuter bridge in the early hours of this morning. ABC News cites an unclassified cybersecurity and infrastructure security report saying the container ship Dolly lost propulsion as it was leaving the port and warned Maryland officials of a possible collision. Maersk issued a statement earlier saying the ship was under its charter. Emergency responders have rescued 2 people from the waters. 1 was seriously injured. The search continues for upwards of 7 people. Maryland's Governor Wes Moore has declared a state of emergency, and traffic has been suspended around the area with motorists advised to avoid the I-695 interstate. Port movements have also been suspended. President Biden gaining ground in 6 of 7 key swing states this month, according to the latest Bloomberg Morning Consult poll. Biden seeing his biggest gains in Pennsylvania and Wisconsin, this following the president's State of the Union, which rallied Democrats and seemed to mitigate concerns about Biden's age. And Krispy Kreme shares are rising after McDonald's said it will begin selling their donuts in restaurants across America, marking the latest attempt by the burger chain to attract breakfast customers and all-day snackers. The chain said tests of customer appetites for the treats, quote, exceeded expectations. The donuts will be first available later this year with a full rollout by the end of 2026. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the programme, the latest on the tragic collapse of a major Baltimore bridge. That conversation up next. Equities on the S&P 500 firmer here by 1/3%. A little bit of a lift, yield lower by a single basis point, 423.36. Under surveillance this morning, the search for survivors from that bridge collapse in Baltimore.
We are still very much in an active search and rescue posture at this point, and we will continue to be for some time. There were likely multiple people on the bridge at the time of the collapse, and that as a result, multiple people were in the water. We may be looking for upwards of 7 individuals. That's the latest information we have.
It's the latest information now. Emergency services have rescued 2 people from the water, one with serious injuries. Governor Wes Moore has declared a state of emergency. Port and motor vehicle traffic has been suspended as rescue operations continue, with drivers advised to avoid the I-695 interstate. Bloomberg's Amy Morris joins us now from Washington. Amy, if we can talk about the latest, please, the search and rescue effort, just where are things currently?
I can tell you that the Port of Baltimore, the law enforcement officials, it's a multi-agency event that's going on right now, a mass casualty event. They are bringing in extra equipment from all over the state and from adjacent states to be able to find people under the water, to be able to find the cars that are under the water. They know there are more people under there. They're using everything from underwater vehicles to sonar to be able to try to locate these people. This is a port city. This is a port area. So they are prepared to go find people and to go rescue people who are underwater. Nothing could have prepared them for the collapse of the Key Bridge. This is a major part of an artery right through this part of the country. I mean, people who live in Washington, D.C. and drive to New York City, that's how they go. They take that bridge, and nothing could have prepared them for this.
Amy, it's going to take some time to establish a very clear picture of what happened here and just what went wrong. There'll be a series of investigations, I'm sure. They could be drawn out. But I think we've put together just a few pieces in the last hour or so as to what happened. Amy, what have we learned?
What we have learned is that the ship, which was licensed by Maersk and under the Singapore flag, had said that it was going through a loss of power, that it was going through some sort of trauma on the ship. You can see the black smoke billowing from it. And the video that you may have already seen of the ship hitting the part of the bridge where it collapsed, all the power was going out. You could see the lights going on and off. It was a mess. They were unable to steer the ship. And so they sent out that mayday, they sent out that call, and that's when they hit the bridge. Now, what remains to be seen is why the bridge collapsed the way it did. Instead of just one part of the bridge falling into the water, the bridge fell in a sequence of events. It was almost like a domino effect falling into the water. The bridge is lost. I mean, there are parts of it that are still sticking up, but they are calling this a total collapse of this bridge. That needs to be investigated as well.
In the meantime, Amy, can you give us a sense of where people are going to be rerouted? You said this is a major artery for everyone who lives in D.C. and in the entire region going from D.C. to New York. What does that mean for congestion there? And what does this mean for congestion at the port that is one of the biggest in the East Coast?
Well, there are detours that are in place. There are tunnels through Baltimore that people can take. However, those tunnels do not allow tractor trailers that are carrying hazardous materials. So all of those trucks will have to be inspected before they can enter the tunnels. It's an option, but it's a very congested option, and it's also going to involve all of these inspections and law enforcement there. So it's going to be very, very, very slow. There are maps already online for where people can follow to try to find their way around this collapsed bridge, going way out west of Baltimore to try to get around it. Most people, if they're having to commute because of work, they might be better off just working from home. We all know that we can do that in most cases, but this is causing a tremendous mess. People are being advised just to stay put until they can figure out a better routes for people.
Amy, can you tell us a little bit about what kind of federal and state response we'll see? Who's actually going to be working on the ground?
We already know that the FBI is on the ground there. And let me clarify something. There is absolutely no indication that this was intentional, that there was any malintent, that this is terrorism. That was one of the first questions that was asked. No, there's no indication of that. Still, the FBI is there because this is their gig. This is what they do. So the FBI is there. We've got state, local, and federal law enforcement, the Department of Transportation, Secretary Pete Buttigieg already been informed, already getting as much information as he can. His office is helping as well. You've got Coast Guard, you've got sonar and radar and the eyes in the skies, if you will. Everybody is actually all hands on deck for this because this is something that our area has really never seen before. It is highly unusual to have a landmark like the Key Bridge in Baltimore just disappear.
Amy, you raised this question. I think it's worth exploring without going too deep into the realm of speculation. To see a collision like that in these pictures lead to a catastrophic collapse of the whole bridge almost immediately will naturally raise questions about the safety of some of these bridges across this country. Now, we can maybe put this particular incident to one side and allow the investigators to do their job. But as you look across the country right now, how big of an issue is that?
Isn't it an enormous issue? That was the first thing that most people asked about was, wow, if this bridge can fall just from this collision, what about the bridges that I take every day to work? Infrastructure has been an issue with the Biden administration from day one, and the money that's been poured into infrastructure has not stopped. It is still coming through. However, this is something that they're going to be investigating. The mayor has already said, and the fire chief has already said in Baltimore, that they have reached out to several engineering companies to come and look and inspect and see where the flaws may have been that would have allowed something as catastrophic as this to have happened. And that is a question that still needs to be answered. But the investigation is ongoing. The priority, however, of course, is the safety.
Amy, thank you for the update and the search and rescue effort ongoing. Amy Morris there in Washington on the latest. Naturally, there's going to be tons of questions, Lisa, one of which would be, when there was a loss of propulsion, how much time was there between then and the collision? How much time would they have had to shut the bridge down and make sure there was no vehicles on there?
And whether this ship was inspected before a 27-day journey to Sri Lanka, and then what other bridges were constructed by the same construction company and architect, potentially?
Yeah, it's going to take time for that investigation to come together. The focus, of course, from officials at the moment is on the search and rescue effort. Equity futures on the S&P 500 positive here by a third of 1%. Up next on the programme, a sprinkle of economic data and reaction from Andrew Holmhorst of Citi. Mike McKee around the table. Some economic data due in about 20 seconds' time. Going into it, the scores that look like this. Equity futures are positive by a third of 1% on the S&P. On the Nasdaq, up a half of 1%. Outperformance on the Russell on the small caps. In the bond market, two-year yield looks a little something like this. 459.10. Yields lower by 3 basis points. On a 10-year, down a single basis point to 423.16. With your economic data, let's get to Mike McKee. Good morning, Mike.
Good morning. Well, we have durable goods orders out this morning, and normally they are something that would give us a clue about business spending, but they do get heavily revised, and Boeing has affected them a lot. The headline number comes in up 1.4%. The ex-transportation up 0.5%. So there's certainly some sort of Boeing connection there that we'll have to look at. The capital goods orders, non-defense ex-air, a strong 0.7% gain after a flat reading last month. Now, capital goods, non-defense ex-air is kind of the proxy for business spending that goes into GDP. And shipments were down 0.4. So that's something that would, this is for the month of February, that would subtract probably or suggest subtraction from GDP. I'll take a look while you guys are checking the markets. I will take a look at what it is that moved this and see how much Boeing might have had an influence on the overall number.
We can run through the three boards, and let's start with equities on the S&P 500. Still basically trading where we were, up a third of 1% on the S&P, likewise on the Nasdaq. In the bond market, let's take a look at the front end of the yield curve. The two-year yield still a little bit lower On a session at the front end, we're down by 3 basis points. On this screen, on a 10-year, we're down by about a basis point to 4.2356, raising some questions, Lisa, about just how many cuts we should be pricing out right now, given how strong this data is.
Well, this has been the continual question, which is if you have a robust economy that's showing signs of green shoots, we heard Matt Kettner saying early cycle, are we really talking about rate cuts? At the same time, a real question here about inflation, and is this inflationary, especially given that some of this is just delayed spending?
Mike, second read on things, what is it?
Well, it looks like there was a significant Boeing effect. Now, Boeing sold 15 airplanes in February, but that was 12 more than the month before. So non-defense aircraft up by 24% in this reading, 24.6%. So a significant boost from that. Also, we saw a big turnaround in autos, transportation equipment up. The motor vehicles are up 1.8%, new orders and shipments up 1.5%. I bring that up because the Port of Baltimore is a place where most of the East Coast imports of autos come through that port. So this could be something that gets interrupted significantly.
Just to sort of follow on and to rip up the script, as Tom Keene would say, how much would greater investment in infrastructure and greater investment in trying to shore up some of these areas that are likely going to get disrupted potentially for a temporary period of time or even longer, how much is that inflationary?
It depends on how it's spent and over what period. It's probably not significantly inflationary. Brookings Institution does a fiscal policy monitor, and they calculate how much additional fiscal help is going into the economy. And right now, they're saying that it's actually negative. The fiscal spend is negative for this year so far and for last year. So we've really dropped off from what we were doing before. But the money is being spent over a longer period of time. And that's where the benefits will come over a longer period of time, that eventually it will be disinflationary if they get this all done.
So basically we were having 2 Big Mac meals, we're just having 1. But we're not on a diet, are we?
Yeah.
I mean, that's the way I'd summarise things in D.C. We're comparing things to pretty extreme deficits, aren't we?
Well, this is going to be an interesting situation because the location of this bridge and the situation that we're going to be in terms of transporting stuff will push Congress, I think, to do some emergency funding for this bridge. We were talking just before the show about how bridges have fallen in recent years, Minneapolis, Philadelphia, and the Bay Bridge after the earthquake, and they get rebuilt much more quickly than they were built in the first place. It took 5 years to build the Francis Scott Key Bridge, and hopefully they can get some kind of replacement going much more quickly than that if Congress will throw some money at it.
It could be a lot of disruption in between. Mike McKee, thank you, sir. Breaking down the data. More upside surprises in America. Let's get to the chief US economist, Andrew Hoddenhorst, to break down some of this. Andrew, you were listening to Mike McKee's breakdown of the data. Your first reaction to it, please.
Yeah, I mean, I think like Mike, I would emphasize that these numbers have really been bounced around by aircraft, by autos. You want to kind of look at the core of it. And what are we seeing at the core is weak, not too exciting, not too positive on the shipment side. We saw that this morning again. I think if you look at the various manufacturing diffusion indices, they've bottomed, they've come off of the bottom, but they're still sitting close to contractionary territory or in contractionary territory. So I don't think we're really changing the narrative around CapEx here.
We're all super familiar with your research. One theme that's come up throughout this year, and I keep seeing it in every single note that you send out, this economy is going to slow down by such an amount that this Federal Reserve is going to need to cut interest rates. You're still thinking about end-of-cycle type stuff, dynamics that are going to become more apparent and obvious through the year. What's leading to that conclusion for you?
It's really the labor market. It's really what we're seeing in the labor market, where you're seeing things like hours worked that are coming down, a hiring rate that's coming down. I think that's why we heard Chair Powell saying in his evaluation of the data, it's not that we're weakening yet, and I would agree with that, but the labor market is his emphasis in terms of a point of concern. It would be mine also.
So do you think that at this point he had the right message? The market's gotten it, and it's only us that's kind of, trying to understand and freak out around it.
Yeah, I mean, I think one thing that was probably constructive that Chair Powell tried to do and that the committee is trying to do is to get away from responding to each individual data point as it comes in. That's a very difficult way to set policy. They're kind of trying to tell us that we're on a path to get to rate cuts now. Inflation has come down enough that they think that they can be cutting interest rates. Now, it's not at all clear that inflation's returned to 2%. And with some of these supply side disruptions, it's a good reminder of why there's still upside risk to inflation.
Let's sit on that that for a minute, because really this is really dominating my thoughts right now is the Baltimore Bridge and what that means for infrastructure spending, what that means for some of the importance right now of getting more spending passed rather than less at a time with the deficit, as John rightly said, is like having 15 Big Macs. So at what point do you see this as an inflationary type of impulse where the U.S. has to keep borrowing, to keep investing, to prop up certain industries at the expense potentially of bond yields and inflation?
Yeah, this comes back to the idea of fiscal space, right? We usually don't really worry too much about fiscal space in the U.S. because politically there always seems to be more space to do more spending. But when you've already done a lot of spending, when you've already put a lot of stimulus into the economy, then when you have real shocks to the economy, clearly no one would disagree that we should be rebuilding this bridge, that we should be investing in infrastructure. But that spending, to John's point, is going to come on top of a large deficit that we're already running. So I think that's where you really get into difficulties, potentially politically, but also economically. Is that also increasing price pressures in the short term? In the long term, investing in infrastructure is going to be deflationary, positive for productivity. But in the short term, you need to hire people. You need to source materials and inputs, and that puts upward pressure on prices.
Public debt situation most urgent I can ever remember is from Larry Fink this morning. What do you think this does in terms of the impact of the dollar?
Yeah, I think that is something that's increasingly in focus. I think we saw a bit of that last year. We saw it maybe less in currencies. We saw it more in treasury yields, where you had the 10-year yield that was upwards of 5%. And I think that was some foreign investor concern that is this a country that is going to run sustainable deficits? They certainly do not look sustainable right now. That's ultimately an issue for the currency also.
I want to build on Lisa's line of questioning around this port in Baltimore and what could develop in the East Coast in the weeks and months to come. Can you help us understand, just frame briefly, how strong the tailwinds are, the disinflationary tailwinds in goods at the moment in America? Because there was some sign in the last few months that maybe that's fading, and I just wonder how vulnerable we are to maybe a re-acceleration in goods prices off the back of a development like this one this morning.
Yeah, I think it's a really important thing to draw attention to, because a lot of the disinflation that we've had has been that goods price disinflation, and that was energy prices coming down. That was supply constraints that had been constraining supply and boosting prices that were relaxing. Look at where we are now. We have gasoline prices that are rising, that are projected to rise further into the summer. We now have this supply side disruption related to the port in Baltimore that would also indicate that, if anything, goods prices could be higher. We already know about the Panama Canal. We know about the Red Sea and the Suez Canal. And we saw in the last inflation report, to your point, core goods prices came up. They've been coming down. They came up in the last report. It doesn't mean they're going to come up in every report, but this period of deflation in goods that we've been in for the last 6 months or so, we're probably coming out of that now.
Do you think services can do the heavy lifting as that develops on the goods side?
So I think that's what you need to have happen to bring inflation down. So in some ways, this kind of idea that the labor market is softening, you really need to see that continue to bring inflation overall down, which is a very unfortunate scenario. We'd like to have a strong labor market, and we'd like to have inflation come down. There's a reason it hasn't happened historically. If goods are going to be less disinflationary, less deflationary, then services need to pick up for that, and that has to be through a softer labor market.
What I hear from you is different to what I heard from the chairman. Is that fair?
I think that's fair.
So basically you're saying to get inflation back to target, we need a recession.
That's still the most likely way you bring inflation back to target. Is there some probability that you get a true soft landing? Sure, there's some probability. But I think what we're seeing is just consistent with the idea that wage growth has kind of stalled out around 4 to 5% by various different measures. If you want wage growth to decelerate further, the labor market probably needs to soften from here.
Do disruptions like what we're going to see inevitably, either on a very small term or potentially medium term, with respect to the Baltimore Bridge and shipping passages, we've seen shipping disrupted in general. Does that make it more or less likely that we'll get the recession that you're talking about to bring inflation under control?
No, so the worst thing that can happen for the economy, the worst thing that can happen for the Fed are these kind of supply side shocks, because what they do is they reduce the productive capacity of the U.S. economy and they boost inflation at the same time. So it's negative for growth, and it means you get higher inflation. It's different than a demand shock where you get stronger growth and you get higher inflation. That's kind of been where we've been.
But this goes to something that John was talking about. If we get that kind of stagflationary shock, which is essentially what you're describing, are the Fed's hands tied, or have they made it clear that they're going to err on the side of supporting the economy and the labor market over continuing the fight for inflation?
I think they're in a transition here, but what they're transitioning to is this increased emphasis on the labor market, on the economy. The idea, which we saw in their summary of economic projections, inflation can run closer to 3% than 2%, and they still plan to cut rates. That's what they have in their projections now. If that number sneaks up a little bit higher on core inflation at the end of this year, and I suspect it will over the course of the year, I think they'll still be cutting.
There's some debate this morning about whether the Federal Reserve is basically saying they've got a higher tolerance for inflation. I'd love your response to that. We caught it with Barclays earlier this morning, who kind of pushed back against that view. Others have endorsed it. Mohamed El-Erian said this could be the beginning of a long story, but the beginning of a story that suggests this Fed is now targeting a range and not a point target. Can I get your view on that?
Yeah, I think implicitly that's true. Explicitly, are we going to hear Fed officials come out and say, you know what, we've gotten comfortable being away from target to the upside? I don't think we're going to hear that in the near term. But this idea that they can accept somewhat stronger inflation, I think everybody would basically say, yeah, 2.5% inflation, that's close enough to 2% inflation. Now, the problem that you get to is, well, is 3% close enough to 2.5%? Is 4% close enough to 3%? And we're kind of in that region now. I think it is a transition, though, where they're moving more towards this kind of labor market concern, economy concern, and the reality is that they will accept higher inflation.
The issue with that, and you know it well, once you begin to give signs, even if you don't say it explicitly, doesn't that make it harder to get back down even more?
Yeah, absolutely. This can easily lock us into, not just a short period, but really a new regime where inflation is higher, more elevated, and more volatile.
This is what Jim Bianco of Bianco Research was talking about yesterday. In fact, I'd go back almost a full 12 months. Richard Clarida, in a secular outlook for PIMCO, coming out and saying this Fed's going to accept 2 point something, which sounded controversial at the time, and it's almost consensus now on Wall Street.
And it's led to this incredible euphoria that people are pointing to in markets because you're basically having the Fed that's got your back and you can eat your cake and have it too. What is the consequence of that? Is it inflation that's not 2 point something, but that's 3 point something, to Andrew's point? And then at what point does the Fed have to say, basta, enough? Like, we gotta actually do something and hold rates higher.
Need to put an Italian on that FOMC, don't we? Andrew, thank you. Andrew Hornhorst of Citi. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. As we've been reporting throughout the morning, a massive search and rescue operation is underway in Baltimore following the collapse of the Francis Scott Key commuter bridge. ABC News reports the container ship Dolly lost propulsion and control, warning Maryland officials of a possible collision. Maersk issued a statement saying the ship was under its charter. Emergency services say 2 people have been rescued from the water. 1 was in a serious condition. They're searching for upwards of 7 others using sonar, infrared, and divers. Traffic in the port and surrounding area remains suspended. A Bloomberg News investigation has found examples of a growing black market for SpaceX's Starlink internet terminals. The access points have been popping up in territories ruled by repressive regimes, including Iran, Sudan, and Yemen, while Ukraine has accused Russian forces of also using the services. Elon Musk says the company isn't knowingly providing the terminals to any of these countries. Former President Donald Trump's social media company is rising ahead of its first session as a publicly listed company. Trump Media and Technology Group will begin trading today on the NASDAQ under the ticker DJT following its merger with a so-called blank check company, or SPAC. The deal gives the parent company of Trump's social media platform, Truth Social, more than $275 million of much-needed capital, plus providing a windfall for Trump as he faces mounting legal and financial issues. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this program, Boeing's C-suite overhaul.
We're going to approach this, number one, acknowledging our mistake.
We fly safe planes. We don't put airplanes in the air that we don't have 100% confidence in.
That conversation up next. The opening bell, 43 minutes away. Equity futures positive by 0.25%. Once again, the data in America pretty decent. Upside surprise. Yields higher now by a single basis point on the 10-year, 425.53. Under surveillance this morning, Boeing's C-suite overhaul.
I didn't know what happened to whoever was supposed to be in the seat next to that hole in the airplane. I got kids, I got grandkids, and so do you. This stuff matters. We're going to approach this, number one, acknowledging our mistake.
We fly safe planes. We don't put airplanes in the air that we don't have 100% confidence in.
It's the latest now. The CEO, Dave Calhoun, saying he'll step down at the end of the year. The news coming just days after major airline CEOs turned up the pressure on the plane makers board, demanding answers after a number of in-flight incidents. For more, I'm pleased to say we're joined by Bob Crandall, the former American Airlines CEO and chairman. Bob, you are a legend in the industry, sir, and we've got a lot to talk about. I want to start with this issue first and foremost, though. Boeing. Your dealings with Boeing, Bob, over the years, your experience and what you think changed in the last decade or so?
Well, I wish I knew the answer to that, and I suspect Dave Calhoun wishes he knows the whole answer as well. During the time that I dealt with Boeing, they were a very reliable supplier. They built great airplanes, and they did a great job servicing those airplanes. And in every case where we had any kind of a disagreement or problem, they stepped up and were very responsive. So our experience with Boeing, my experience with Boeing has been that it's a great company. And of course, everybody in America is worried about what happened. And as the airlines, the people that are running the airlines these days, the CEOs of the major carriers, are going to meet this week with members of the board of Boeing. And that's an extraordinary thing that has not happened in years past. And it's a reflection of how serious the carriers in this country regard this problem.
Bob, as a customer, what choice do you have but to stick with Boeing? Can you help us understand the decision in front of you when you were CEO to go between, say, Boeing or an Airbus? What's the choice you've got to make? What do you look for?
Well, look, nobody wants to be subject to a monopoly provider. So what you look for in airplanes are certainly reliability. Safety has always been table stakes in the manufacturing of airplanes. So no airline ever wants to have an accident. And for the most part, U.S. aviation has built an extraordinary safety record. And so when you're looking at Airbus and Boeing as to purchasing airplanes, what you try to do is you try to find the best quality, the best price, the best operating costs. And when possible, you buy, if you're a big enough airline so that you can tolerate the costs of operating multiple fleets, you try to use the competition between those two manufacturers to sustain your own cost per aircraft or cost per available seat mile. And by competing them against one another. And that's what everybody wants. But table stakes, as I say, safety at table stakes. So without an absolute reputation for safety and consistency, you simply can't compete. And that's why everybody's worried about Boeing. We've got to get Boeing back to the point where it produces an impeccable product.
Bob, it's not just Boeing, though. We're also hearing about more small incidents and medium-sized ones at airports and questions about air traffic controllers and a lack of staff. Is this all just because of the pandemic? Is it just that we're hearing about these things and didn't used to? Or is it lack of infrastructure investment? Can you identify why we're hearing more about the bread and butter of the industry being challenged, which is safety?
Well, I think we're hearing a lot more of that for several reasons. One of them is the Congress's failure to raise taxes enough so that the U.S. government has enough money to do the job properly. We have been underinvesting in our air traffic control system. We have been underinvesting in our roads and bridges. And until we step up and fix that problem, I think we're going to continue to have the kind of problems to which you refer. And certainly air traffic control systems. We used to be the leader in the world. We are falling behind what the Europeans are doing, what people in other parts of the world are doing, and we need to fix that. And in order to fix it, we need to provide appropriate resources.
All right, so to fix that and to try to mitigate some of these trust issues the American public has with Boeing right now, as well as airline CEOs, do they need to look outside the company, given the crisis of culture that's been developing within Boeing?
Well, look, I don't know what's gone wrong with Boeing, and I suspect Dave Calhoun doesn't either. In a statement that he said, we're gonna look very carefully at this, and we're gonna learn from our mistakes. I don't know explicitly what those mistakes were. Was it a mistake to acquire Douglas a decade and a half ago? Maybe so. Was it a mistake to lay off as many engineers as they did in the COVID years? Maybe so. Has it been a mistake to outsource some of the work away from their own workforce? Maybe so. I don't know the answers to those things. And Dave Calhoun, up to this point, hasn't made clear that he knows the answers either. But we need to fix that. And to fix it, we've got to reinstate the culture of quality so that every man, every woman turning a wrench, building an airplane, doing a piece of wiring on an airplane, everybody feels that sense of personal responsibility, which will make that airplane come out of the manufacturing facility in perfect condition.
Bob, let's finish on a lighter note. Speaking of responsibility, you are responsible for the frequent flying program that was introduced at American Airlines. You revolutionized the industry. I just want your opinion on things, on where we are now. Did you ever think we'd be where we are now? Did you ever think, and my colleague Lisa talks about this a lot, that ultimately airlines would turn into credit card companies? Bob, did you ever see that happening?
To be honest, when we invented it, we thought it was a good idea. But I quite, in all honesty, I never anticipated that it would be as great a success as it has been. And of course, we're very pleased by that.
I have a complaint. Don't you think you should get miles to be rewarded for flying, not for spending money on other things? Don't you agree with that, Bob?
No, I don't think I agree with that. I think it's a good thing that you can buy lots of things with miles.
Of course he's not going to agree with that.
As a consequence of that mileage business is a good business.
Bob, I'm going to let you go, but I do want to know how you get concierge key, so you can tell me in the next commercial break, OK? Just not on air. Bob, thank you, sir. Bob Crandall there, the former American Airlines CEO. Legend.
He wasn't going to answer that question
with
anything that you wanted, because it's basically giving them all the money to do what they need to do.
Inquiring minds who fly American want to know, how do you get concierge key?
Yeah. You think he's going to tell you?
I just want to know. How many miles is it?
Just give you the key.
Or maybe you just go around spending lots of money on a credit card. I've got no idea.
Go crush it.
Coming up tomorrow, Bruce Katzman of JP Morgan, Katie Nixon of Northern Trust.
Welcome back to another Miami Open update for Bloomberg TV and radio from Tennis Channel. Fourth seed Alexander Zverev came through his rain-interrupted third-round match against Chris Eubanks to move on to the round of 16. The German handled the American's big serving game and got the decisive break early in the second set before putting the comfortable win in the books. He'll face Karen Khachanov for a spot in the quarters. And don't forget, Tennis Channel's daily live coverage starts at 11 a.m. Eastern.